Hey, fools, and hey, Seth, Jayson, how are you, sir?
Hey, Jason Hall. We only have two Jasons this time, not three the last time we met online.
That's okay. The universe is probably safer that way, a little more stable reality when we do it that way.
We don't spin off into some branch of the multiverse.
That's right. That's right. But we are actually expanding this multiverse a little bit. Not only are we in front of Motley Fool members with Fool24, but we're also live on YouTube this hour. So that means we want to answer questions from Motley Fool members and also people that are watching on our YouTube channel. So the way you get us those questions as a starting point, you go to slido.com. The event code is Fool24, all one word. Put it in there, Fool24, and get those questions into us. I also want to be clear, so you have a sense of basis of understanding what we're doing, is we're giving our insights and expertise. Between the two of us, we have a lot of experience and expertise in a lot of different topics around investing, but we are not here to provide individual investing advice for a million reasons, including a couple of strangers on the internet, right? You wouldn't want them to be giving you individual investing advice, plus all the legal reasons that we wouldn't be doing that anyway, right, Jayson?
You want our kids to continue to eat and have education, right? You don't want us eating dog food. Don't make us answer those questions that'll have us eating dog food.
Exactly. Exactly. So keep that in mind as we do answer, but we do want to answer them and give our insights. So keep them coming in. Our theme for this hour, chips, clouds, and more. And there were a couple companies, Jayson, there were a couple companies that you wanted to highlight that might be part of our discussion today. Some things that are going on.
Yeah, I thought it'd be fun to check in with some companies I haven't looked at for a while, and one that I follow a little more closely, Rocket Lab, RKLB, one of them. And that's a fun company to own and follow. It's kind of a hobby stock. We'll talk about why in a minute. But then like HP, ticker HPQ, and Dell, ticker Dell. Haven't looked at for a while. I follow the AI space very closely, look at all the hardware makers, see what software is spinning out and so on. And I thought, geez, I need to check in with them and see how their server sales and PC sales are going in relationship to that entire movement. And so I did a little homework on them this morning, and those are the companies I've prepped to discuss. Have you got anything else on your mind to seed the question queue?
Yeah, I like, so around Rocket Lab, I just directionally and thinking about it as a framework, it's an interesting business that they actually have a business, right? It's a hard business, but it's like a real business where they're actually growing it. But it also falls into that category of dangerous stocks, of story stocks, right, Seth?
Yeah.
Where we can fall in love
After
with an
the
idea.
yeah. Yeah, like
And
after it, I went and looked the other day, like shortly after the election, or even like right around the inauguration or something. It was just up to $30 all of a sudden from $20, and I was going, "Why? Like,
yeah,
what was the deal?" And it's back down to 20-ish bucks, and the reason was people just got excited.
right, right. And that happens, and stocks do get caught up in the kind of the animal spirits and go to extreme heights that are completely dislocated from the business. But also, unlike Rocket Lab, a lot of times we see businesses that are more idea than business, and they really have no fundamental business at this point. They're somewhere between marketing idea, science projects, and real world R&D in some level of development. So I think it's a good opportunity to maybe talk about the difference between those kinds of stocks and businesses out there.
Yeah, and it's sometimes easy to get confused, even if you've got experience in doing this. And some of these, unfortunately, even turn out to be scams after you look at them for a while. Rocket Lab, not one of these. And I was actually impressed. My biggest beef with Rocket Lab over the last couple of years has been like, when are they going to turn it around and become less unprofitable, right?
Yeah, right.
And Rocket Lab, for those who don't know, Rocket Lab, the guy who runs it, Peter Beck, New Zealander, he was like a washing machine engineer. He's a very talented engineer.
Let me correct you, Seth. It's Sir Peter Beck.
Peter Beck now, right? Yeah. And wanted to make rockets and send stuff into space, and people thought he was crazy, and he got some seed money and he started doing it. and the company grew, and so they specialize at this point in two things. Well, the first thing they specialized in was small launch, so smaller rockets, less expensive to launch, hopefully a quicker pace once you get going, and that's their system called Electron. And then they started kind of vertically, I wouldn't just call it vertically integrated. It's almost like I feel like it's more like a horizontal grab and gather, but it essentially turns into vertical integration, which is their space systems business, which is now 2/3 of the business. And this is where they build anything from specialized space components all the way up to entire satellites. They kind of announced a white box satellite in their last call, where they call it the flatellite, that they say they'll be able to pack a whole bunch of them in. And you kind of pick what you want to do on those satellites. They'll put together the constellation and launch it. And from their bigger upcoming vehicle, Neutron, which we'll probably talk about in a minute. But in the meantime, the last earnings report showed sort of really good revenue growth, and it showed a big, let's try not to invert the universe, a big decrease in unprofitability, right? They became much less unprofitable.
Natasha, I'm going to send a screen share here over. This is actually I'm going to show, you'll see their guidance that'll come up. I think that's one of the things you wanted to talk about here.
Yeah. And so I was very impressed with everything I saw. They're also taking that Electron and advancing it into what is called a hypersonic delivery platform, and that's still a bit more science project-y, except that they've done a couple of launches in that, and those come at a much higher margin, because basically that's like taking a rocket and only flying it like halfway across the planet, right? It'll get up there and go at hypersonic speeds and get the payload there. And anyone who wants to do that is going to be in a hurry. It's probably going to be a defense contractor, or a defense, for defense purposes. And the price tag is going to not be quibbled about too much. So that is Rocket Lab's sort of current business. And then the next thing coming up, maybe you want to tell us about Neutron, which is an interesting upscaling of the business.
Well, it is, and it's interesting, because I think one of the things with Neutron that maybe gets a little bit misunderstood is the idea that they're scaling up and getting larger, because with their delivery systems, because the reality with space is space launches is unlike literally every other industry that we follow, where bigger typically works out better, where you get larger and you can drive costs out, you can be more efficient with your manufacturing, you can get better margins. The problem with space, with the things that you're shooting into space, the more your delivery system weighs, the more payload you have on, the more energy it takes to get it up, which means you need more fuel. The more fuel you add, the more thrust you need to lift the fuel. And it's this hard problem of where the bigger it gets, the more fuel you need, the bigger the thrust is, the more thrust you have, the more fuel you need to feed it. So going smaller,
got to explode all at once. It's not like sending everything out in a fleet of semis where they all get your company got bigger, so now you put stuff in 100 semis instead of 20. That's not the case. This is like everything's in one semi and you light a match under it, right?
Yeah. I want to try to find I can't remember which presentation has the best
visual of the Hungry Hippo and the Neutron.
Yeah, exactly.
Well, I'll imitate it. So one of the interesting things is that for a long time, Sir Peter said, we're not going to play in the larger rocket space because it's harder to make money there. We're going to specialize here. And he said, if we ever do that, I'll eat my hat or something. And then when they decided to do it, he did a video. He threw a hat in a blender and he ate some of it, because he said, look, here's Neutron. And Neutron is going to have a front fairing that will pop open like a hungry hippo mouth, and then
you go right here,
get shoved out, and then
if you can share that, Natasha. But no, this is exactly it. It's exactly what you said. This right here. Yep.
It's one lip short of a dune sandworm, right?
Right, with the three that open up, a lot less teeth too. So go ahead, Seth.
Yeah. So Neutron will get them kind of into the mid section of launch, where there is still probably more demand at this point than supply. And one of the other things they're doing, so Neutron is still in development. They expect to launch the first one. They said
second half of the
Of the
year.
year.
Yeah, second half of the year. Right.
And they expect to try to orbit it the first time around. And the first one, they're not going to try to attempt to land it on a ship, but they bought a ship and they're fitting it to be a landing ship. And one difference that I think between Rocket Lab and some other companies out here that you might have heard of is they actually are paying attention to cost, and they named the ship return on investment. They did that in honor of the CFO, I guess. In other words, they're not just trying to build cool things. They want this company to at least be self-funding and hopefully make money. And so they're thinking about all this in terms of ultimate profitability. Yeah, and there we get some of the scale.
Yeah, I wanted to talk about that. I want to go back here first, because this includes the rocket itself, right? Where you can see how large that is. And again, it's still that same physics problem where, as massive of an amount of payload as this is, when you compare it to the size of a person, it's still those challenging physics. But it's scaling up from where they started, where they said they'd never go, but it's still not the Mars level of giant system that SpaceX is trying to develop, for example.
This isn't a Saturn V, much less a Starship or a space launch system or anything like that in size.
Right.
Yeah. What's also interesting and fun for me as a guy who builds carbon fiber bikes in the garage in his spare time, Rocket Lab's doing a lot with carbon fiber still. Neutron is a large part carbon fiber construction. Carbon fiber has various gives and takes as a material to use for anything. Like anything, you got to choose the material that works best for the job. Interestingly, if I remember correctly, Starship was originally to be carbon fiber, and they even had like giant molds to which they applied things, and they actually like threw out all that tooling years ago and decided to go with stainless steel on the outside. But Rocket Lab sticking with carbon fiber, so they must figure that they have that they know how to make that work. And I don't doubt that they've thought about it very, very carefully. But composite construction on the plus side can be very light, especially for the stiffness that you get out of it. Carbon fiber, when it's in a composite matrix, especially the aerospace stuff, or even carbon fiber when you buy it. When you're a schlubber like me, when you buy it in one of like 3 or 4. They tend to think of it in terms of quality, but it's not really quality. It's stiffness is. So like the lowest level is regular stiffness. And then as you go up towards like the stuff they'd use in an airplane, it gets stiffer. The stuff they use in space flight gets even stiffer yet. And if you think about it, there's a good reason for that. If a part on a satellite like flexes even a tiny bit more than you want, and say it happens to be holding on to like a thruster or something, a few million miles down the road, how far off are you going to be from where you wanted to be? Right.
And precision matters.
Yeah. And so I can't speak to the argument over whether like this is the right material to make it out of. You know, the rockets. I was born the day we first landed on the moon. On the opposite side of that wall, I have signed photos from Buzz, Neil, and Mike Collins. That's cool. All on a frame, plus an Apollo 11 patch. Back then, the rockets were all made of aluminum and titanium and stuff. And that worked well enough for them. But Rocket Lab is going with carbon fiber composite, it looks like, for most of Neutron, which, again, they expect to get going starting next year. And so I think they said that because of the costs of building the infrastructure needed to launch that, you need bigger launch facilities, you need bigger launch safety pieces, all sorts of stuff. Next year is going to be a little more cash burn, capital spend than prior years, and then they hope to get things going after that. But they still got a really big backlog. They're doing a ton of interesting science, including like delivering whole satellites to other companies that are doing stuff with them.
Mhm.
And some of this, most of it eventually goes back to some form of government spending. So even if the breakdown looks like it's sort of 50% government and then 50% private, those privates are probably doing a lot of work for the government. So there's always that little bit of risk there. However, in the current cost-cutting climate, cool stuff like space seems to be off the chopping block for now.
Mhm.
And
Well,
so I think there's a little less risk here than there might be otherwise.
I think it's notable too, and on one hand, this might come as a swipe at SpaceX and Musk, and I don't mean it to be that way, but and SpaceX is private, so we have a lot less insight into all of their business and revenues. But we do know there's a lot of related party transactions that's happening there with SpaceX, with revenue from the satellite business, for example. And Rocket Lab doesn't have that same benefit, so to speak. It's having to deal with completely independent parties for a lot of its revenue. And I mean, that to me, that is a bit of a qualification of the quality of what they're delivering to the market, that it continues to grow at the rates that it has without having a related business that it can rely on to provide some revenue and support launches.
Yeah. I am usually really super skeptical of this kind of story because
Mhm.
they're so often just tailor made to be like a meme stock or something. This one
Absolutely.
I've always thought like I just I just don't get a lot of BS from them.
Yeah.
They never set off my BS sensors in any way, and that is like the highest praise I can give them as a super skeptic. Own it myself, have recommended it. And you know, you still probably want to think of it a little bit in terms of it's similar to like a biotech, and the results are a little bit kind of binary, but
Mhm.
less so now that they have space systems
Yeah.
and they're doing so much work, building things and delivering parts to others who are building satellites and launching. And by the way, that also means it's much less lumpy. The launch business can be really lumpy if because people don't deliver you the satellite on time, or they don't have the money to spend when on schedule, so that business can be very lumpy. So the space systems business smooths that out to a large degree, which is also interesting. And when I first got interested in the stock, that part of the business almost didn't exist, and
Yeah.
that's all been sort of built since then. And among that business, there's like specialized solar panels for spacecraft, and little servos and actuators and motors and just about anything that would go on a satellite to make it do stuff out in space. You can buy that kind of stuff from Rocket Lab.
Yeah. Like you said, not risk free, but still binary ish. Um, because to get to even to earn, I think the market cap is around 8.5, close to $9 billion at this point. That's really expensive if the things that they're trying to deliver don't pan out and create economic value.
Yeah.
But it does look like they've shown some pretty decent margins. Like if we try and adjust out as much as we can, how much of the expense plus the capital costs that are going towards building for the bigger future, the economics are compelling.
Yeah, let me just look here at my notes quickly, like just to get an eyeball on the gross margin. So some of you probably don't know. From the old days, I built long before AI and LLM was writing articles about earnings. I built these robots that write articles about earnings based in Excel. And
Right.
my favorite thing about them is they never get the math wrong. And they make pictures. So so if you're not very smart like me, you can look at the picture and see how the numbers compare without doing the math. And so Rocket Lab's last earnings, which I have here, the 10K was filed Feb 27th. I'm not sure exactly when earnings came out, probably
Same day.
very close to the
Same
same
day.
day.
They actually file their
Yeah, a lot of them
filings
do.
when they release. That's not
Yeah.
normal.
Yeah. So that's good. And so Gap sales were 120% higher than the prior year quarters, 160 million, which was pretty good. And earnings per share negative 6 cents. But a little bit about the same as the Gap EPS were about the same as a prior year quarter. There's some adjustments there. But I want to look at my margin chart here. The gross margin was 200 basis points better than the prior year quarter, 27.8%. They said some of that was due to the haste, like the couple of hypersonic / suborbital launches that carry the higher margin. The operating margin went from the prior year at being negative 80% to negative 40%. Okay, I know you're like negative 40%, dude. What's your deal? But I mean, that's a pretty good improvement. Net margin did about the same. So it's moving the right direction, in my opinion. And like I said, I'm pretty harsh on this kind of company. And I still get the good vibes from them.
Yeah. But I mean, see, I think when you're looking at a company that is that speculative, you have to hold them to a high standard to deliver directionally the improvements you see to get to a point where the business can live off of its own operations, right?
Yeah.
And I get to the point where it can earn capital at a reasonable cost if it does need to take on debt.
Yeah, and we should probably point out that over the past few years, a few others who have tried to get into the small launch biz have just failed entirely. They've fizzled out. Their stuff didn't work, and they fell apart, and we haven't heard from them since. And there were like 2 or 3 that I can't remember all of them. Kind of from coming out of COVID and the whole SPAC-a-mania thing, to here. So, Rocket Lab is sort of the second most launches behind SpaceX at this point for this private, especially for the smaller stuff. I mean, they're in the lead. So it's just a really interesting company. And if you like this kind of stuff and you think the stock price is okay, I always say, again, this is trading costs are like free now. So you can buy a little bit of these companies and watch them. And I always think like the best post-it note for any company you're interested in is a few shares on your brokerage statement.
I agree. It triggers something in our psyche where we actually pay more attention. Skin in the game is a real thing. It really makes a difference. Seth, there's a couple questions that have come in that I think would be good for us to take a stab at.
Sure.
They both actually came in. One came in the prior hour. One came in at the beginning of this show. And this is going to be a little bit of bonus for people that are watching on YouTube right now that are not members of the Motley Fool, because we're going to talk about some stocks, or a stock, in this case, Snowflake, that's been recommended to members in multiple services. And Shotgun Santa's question lays that out. So here's a little inside cooking, but it's also, I think, going to be informative for members that don't really know, but also for anybody that's not a member now and ever considered joining the Motley Fool, one of the services, so you understand something about the culture of the business. So Shotgun Santa's comment and question, one thing I get confused by, Snowflake, for example, Snowflake ticker is SNOW. It's been a recommendation in Stock Advisor, Hidden Gems, Rule Breakers, Money Makers, and then a sell came from Money Makers last year. Is Snowflake still a recommendation or not being followed? I love this because, Seth, it's right in the name, Motley Fool. So we have a number of different services with different advisors, and the services are looking for different things. And the goals of the portfolio that they're building, if it's a portfolio service, may be different than other services. Some of these, like Stock Advisor, they're stock idea services. They're not a portfolio, right? So number one, with each of these different products, it has its own goals and advisors that are looking for specific things. So that's the Motley. And members that have, depending on what level of member you are, you have access to different services based on what you're looking to accomplish with your own goals and the kind of stocks that you might be looking to invest in. And sometimes that leads to this confusion where you may have a very popular company that ends up in multiple services, but at some point along the way, that confluence turns into a divergence where you get services that come to different conclusions about stocks for a litany of different reasons. And in this case, the question is, Snowflake still a rec or not being followed? Moneymakers recommended a sell. So that specific service, which was kind of a combination of stocks that we think should be relatively, from the time that they're recommended, a relatively good bet on low risk of capital losses. This stock should generate return for investors over, a 5+ year holding period. And that might include dividends, but it's mostly we think it's a great valuation and a solid, relatively safe business from this price. They made the decision that Snowflake didn't fit within that profile for whatever reason the advisors reached. And we have other services that it's still an active recommendation in. Seth, as an advisor, as an active stock picker for services in the Motley Fool, I'd love to hear your insights broadly and also maybe about Snowflake directly.
Yeah. Snowflake, I don't follow personally very closely. And so I'm not familiar with this case, but what often happens is there can be some confusion, especially for folks who have multiple services. The way to think of it is I didn't buy an Motley Fool. You got, this service, which is run by these advisors, and maybe you have this one and this one. And like you said, they may at some point agree that all of them agree that, hey, whatever stock is a hold. And at some point, another service that holds that stock might say it no longer fits with what I want. And that could be for many reasons. They could say like, well, it gets just such a large, if it's a portfolio service, for instance, they might say like, this has grown to be such a huge piece, we're just going to sell half of it possibly. Yep. That is the kind of decision that can be made in some of those. Notional services where there's just sort of recommendations. You don't really have the option of saying, I want to sell half of this, but you might say, you might just disagree on the end market or the valuation. You might still think a company is a great company and that it's going to make a lot of money, but you might look at the valuation and say like, I just don't think it's going to grow into that valuation. Or you say, I think the odds that it's going to grow into that valuation are maybe, I don't know, 40%, but the odds that it gets crushed for this reason are 60%. And you average that out and that comes to a sell for me. That can happen, every day, every time you buy a stock, someone sold it to you. So people disagree on the value of
what makes a market, right, Seth?
Yeah, literally every time it trades hands. I mean, I guess market makers are in the middle doing it just to shave their pennies. But you get our point. There's a disagreement at the heart of every single transaction.
One of the things that I want to suggest here to anybody that's in this situation as a member is, as a starting point, I think one of the things that we naturally do. I started off as a member, Seth, back in 2009.
Yeah, and I started the same way, just a little earlier. Yep.
So a lot of us here did. And one of the lessons that I learned as a member is to not be binary in my thinking about buy recommendation, sell recommendation, but get into the nuance of not the what as much as the why that matters. So if I was a member of Stock Advisor and Rule Breakers for almost my entire time. I was an investor. I was a member of one of the dividend services, and I ran into this a couple of times. And what I was told to do, and it was so useful in reframing the way I thought about it, is go back to the service that made the decision that was different, that I was confused by. Read the recommendation, that sell recommendation, really focus on the why that decision was made within the context of that particular service and what the goals were for that service. Go back and read the most recent updates and the other services around that stock. Think about within the parameters of what are those particular services, what are the goals, and which is more aligned with me. What am I trying to do? And then the very last thing, the most important thing, do my own homework, do my own due diligence, and then make the decision about what was the best thing for me to do as an investor with my money in the real world, right? And we have to do this every day with every stock that we own or we're considering buying, that we don't own, is really be mindful about all of the sources of information from internally, from the things that we pay for, the external sources that we're not paying for, but somebody's getting paid to produce it, and whatever their motivations are, and then get back to our core goals individually. And how does the information that I have inform what is the right thing for me to do, or is close to the right thing for me to do going forward?
Yeah. I mean, it's different for everybody, right? It's and like if you're a geezer and say you own a bunch of Snowflake or whatever it was, and it's worth a ton of money, and like if it went down by 25%, it would make a huge difference in your retirement or something.
Yeah.
You have a very different decision to make, and you may want to sell, much more quickly than somebody who, say has a ton of money and for whom this is a smaller position. And if this position changed, it wouldn't affect their quality of life now or in the future at all. Those
Right.
people, those two hypothetical people could come to completely different decisions. Neither one of them is wrong. And
Yeah.
one of the final things I think that all investors need to do is like embrace information that does not confirm your current state of mind or your
Yeah.
I want you use the term bias, but I don't really mean it the way people say, like embrace
No,
the information
bias.
that
Confirmation. Let's put it out there. Confirmation bias is the biggest problem that most investors have to fight against. And that's finding something that tells you that you're right. Right.
Yeah, you want everyone to tell you right. Like, so this to me is always the worst. I'm always frustrated. I used to love reading I still love reading short reports. I used to write about scam companies. I got threatened. People told me the Russian mafia was after me. I got sued one time for a couple $1,000,000 by this company because I simply told the story of their CEO who had just gone through one from the other to the other, like riding the tail end of tech waves and never running a company that actually made any money and just kind of skipping away once people forgot about it. And people hated that because they were like, how dare you take money out of my pocket? You have to read this stuff because you're not getting all the information if you don't. I think the funniest, I have to share this one. Can I share it? It's a little PG-13. I was at the doctor's office one time, part of the physical, literally like right before a certain part of the physical where the doctor is putting on the glove, snap. He says, every time you write an article about X company, whichever it was, he says, I lose money. And I was like, what? But he had been investing in a company that was like a penny stock, and it was a straight up scam. I mean, it was a straight up scam, and he lost his money, and it wasn't my fault. I mean, I wasn't the only one writing about this company and how it was a scam.
Right.
But to hear that right as he's putting on the glove, he was actually, that was a bit of drama from him. He was actually ultimately thankful because he learned a lesson that you cannot learn any other way. But you have to embrace the information that doesn't confirm your bias or your narrative because, it might be right.
Yeah, no,
it might be part right. It might be all the way right. And and we always like this. And the other thing that's weird is when a stock goes down, we're always like, oh my God, what happened to me? And when a stock goes up for no reason, we're like, look at how smart I am. Look how smart I was.
Yeah, no, that's exactly right. So that's why I agree. It is so important to be constantly like poking holes in whatever your thesis is, because you can be right 99 times about your best idea. All it takes is being wrong about one thing that you missed or overlooked, and being right all of those other things, Seth, it doesn't matter, right? That's why it's so important to try to disprove your thesis.
And you
all right, so you want to go ahead.
You can have those huge mistakes too if your positions are sized properly for your risk tolerance, right?
Exactly right. Yeah.
Like, oh my God, I lost 100% of that. Well, if it was 2% of your investments, that kind of sucks. But it was 2% of your investments.
There you go. Especially if that other 98% of your capital was in a couple of good ideas that you can be 100% wrong, but you can be, thousands of percent right.
Exactly.
And that's the beauty of investing. So you mentioned a couple of tech hardware players out there that you wanted to talk a little bit about. I'd be curious to hear what's going on in the world of legacy PC. Is it still a Dell dude?
So Dell is, I don't even know if does anybody even remember Dell at all? So, when you and I are probably close to the same geezer age, like Dell was the company that grew out of Michael Dell's dorm room business of building custom computers. And back in the day, do you ever remember getting the big, thick computer catalog to like pick out components for your PC? This was what everybody did. They picked out every single thing. It's hard to believe anyone would want to do that. Although I still go to Micro Center. This ugly machine here I built by hand. People still do this. They just tend to put them together by hand. And then Dell, of course, grew into a giant PC maker plus server maker plus other stuff. And so I thought, like, let me check in with Dell. And as you can imagine, they are doing some decent business selling AI servers. And I believe they say, and I believe I read this somewhere else too, so I'm going to go ahead and say it was correct, that they were the first to deliver the highest end Blackwell NVIDIA hardware kind of integrated into the 72 unit rack, which is, this enormous liquid cooled thing that can crunch lots of numbers very quickly. But let me get just like to the headline numbers from their latest report. They missed slightly on revenues. So these days, Dell's doing like 24 billion in revenue, the last quarter here, which ended January 2025. And that sales number was only 7.2% higher than the prior year quarter. So kind of a slow growth business these days, earning a couple of bucks a share that quarter. And they beat the estimates a little bit there as well. And their gross margins were down slightly. And I mentioned that because we'll get to a little bit of detail in a second. Operating margin was down a little bit, but net margin was up. That's all calculated in GAAP terms. And so one of the interesting things to note about Dell is probably true for some of the other businesses as well. So Dell's doing a decent job selling these AI servers, which are, they're in the midst of having to do a lot of engineering to do these as well, because these suckers are now running so hot that you've got to have liquid cooling integrated into them if you don't want, to light the buildings on fire. Probably light the concrete on fire with the amount of heat these things throw out. And so they bragged that, let me read one of these notes here. We launched Dell Infrastructure Rack Scalable, our IR7000, provide up to 96 GPUs in a rack and 786 GPUs in a scalable unit. We introduced direct-to-chip liquid cooling in the XE9680, which lets them put 33% more high-powered GPUs in a box, because the heat is being taken away by liquid rather than just relying on air to move it. But that comes out to only 7% revenue growth latest quarter. EPS was up 18%. Dell is buying back a lot of shares, but unlike a lot of tech companies out there these days, the share count's actually going down. So I don't penalize them.
That's one of my biggest peeves, Seth. My biggest pet peeves is when you see this multi-billion-dollar announcement about share buybacks, and then you actually compare the share count at the end of that period to where it was a year ago, and the share count is up.
Well, I in my spreadsheet I have that has graphs that show all this stuff. Like I have about 5 different bar lines that are different kinds of free cash flow. And in one of them, I take out the amount of free cash flow. I take the free cash flow and then I subtract the amount of cash that was spent on buybacks.
Right.
And that's not perfect. I then need to go check and and see what's happening to the share count. I could probably grab a piece of information that would do that all for me automatically. But my point is, like, if the share count is flat, it means all those buybacks are really just kind of compensation. And maybe you don't want to count them as free cash flow as an outside investor. And for a lot of companies out there that are producing great free cash flow, 2/3 or more of it may be just going to share buybacks that do not decrease the share count, which is something that's really important to think about as an outside investor. But Dell's, I wanted to mention that one of the things that is interesting, and it may be something that needs to change someday, is that the gross margins on those AI servers are lower than their traditional server gross margins. There's probably a lot of reasons for that, including the cost of the hardware, the new engineering they're doing to make them work and everything. But Dell also is still seeing, they were seeing double-digit growth. I'm guessing that means like 11%-ish in traditional servers. So everyone thinks that traditional CPU-based servers are dead. And there's a report from Gartner I went through several weeks ago that also makes it clear this isn't true at all. They're still growing. It's just that the growth rate is so much smaller than the GPU server growth rate for AI data centers that it looks like it's not growing by comparison. And Dell also, interestingly, like they're the market leader in in monitors, which is something that a lot of people might not know. And I never thought about it, even though most of the monitors in this room are Dell monitors, because whenever I look for a new monitor, I do some photography and some other stuff. And so I don't buy the super high-end photography video monitors, but I need one that's pretty decent at those kinds of things. And the Dells are always really solid for a pretty good price.
Right.
And I think that's reflected in that they've got like 18.5% market monitor share. And monitors, it would seem like those should be a nothing business, but Dell does okay with it. So if you want to look at Dell like as a valuation, let me punch it up here. Let me look at my notes here.
I bet it's cheaper than Supermicro computer.
Yeah, but growing at a lot smaller rate, probably, right? But let me look here at my graph that says it's trading at, see, even as nice as it looks, Dell's still only trading like a 2.2% free cash flow yield.
Which is expensive.
What is expensive? So that basically, like, we call that 2%. And like, say that if growth is kind of flatline, I always like to say, if Jayson and I were selling you a car wash, and we said it's growing like 5% a year, you'd be like, okay, how much cash can I get out of it? And in your mind, you'd be thinking, how soon am I paying off the price of this car wash? And if we said 50 years from now, you will have earned enough cash to pay back the price of the car wash, you would tell us to go pound sand.
Yeah, you wouldn't buy that car wash. That's exactly right.
But some of these businesses are growing at car wash kind of rates.
And
have a lot more balls to keep juggling in the air than you do if you own the car wash. I always talk about car wash because one of our friends, one of our colleagues who's now in a different part of the business, his dream was to own a car wash. He just, the self-serve kind, he just loved the idea of people coming in, doing their own labor and just giving him money. Car washes, by the way, the fancier full service ones are in a bubble right now. There's been a few articles about that nationwide, and there's one down the road for me that's super popular that backs up traffic on a busy road for like a mile.
Well, I think it moves in that's a little bit of like a real estate play too with that sort of thing. It was the self-storage was a bubble. And so now it's moving into car wash. What's next? We got a
fancy car wash. So yeah, Dell, I thought was interesting. There wasn't a lot of surprises. I was kind of hoping I would find like, oh, look, here's a little value play here. It looks like a pretty solid business, but we just talked about how people might have a different opinion on whether or not you buy a stock. Even if you like the business, I think most of us would look at this Dell business and say pretty solid, making cash, buying back shares. However, at that price, just not so compelling for me, and probably you thought the same thing.
Yeah, I think so. And just we can we've got some more questions that have come in, Seth. And they're mostly for you, which is fantastic because you know a lot of good things. But I want to I want to have a little bit of a kind of a mindset about valuation talk. Before I do that, just want to remind all of our YouTubers that are watching right now that you're watching along with Motley Fool members who are old hats at how to do this, but you might want to get a question to us. If you're watching on YouTube, go to slido.com, put in the event code Fool24. You can submit questions to us, get those questions to us. So what I wanted to say, Seth, is important. I love like free cash flow yield, as a proxy for thinking about valuation. But a lot of it is the growth rate. And with a company, again, like Dell, that's growing at these relatively low rates, if we could try and find a terminal growth rate, like across the cycle of demand, that terminal growth rate is going to be very slow versus, I mentioned Supermicro. Let's assume that their terminal rate of growth is going to be much higher than Dell's. You could arrive at a higher valuation that could still make more sense in terms of the returns that you can get because of its ability to grow earnings per share for free cash flow per share and grow into that valuation a much faster rate that should lead to acceptable returns, even paying a higher valuation. So that's why you might hear somebody describe a Dell that probably trades for a lower price to free cash flow than some of these other higher growth companies. But the higher growth companies might be a more attractive buy right now because, again, their ability to grow into that valuation is a more direct line to better returns
Yeah,
than
at least you hope, right? So when I
you
pull up
hope,
my
of course.
when I pull up Super Micro on my fancy dancy sheet here, so I see for them that like all the free cash flow figs are firmly in the negative. The most vanilla one, just like free cash flow. What have I got here? I'm hovering. Why isn't that? Why is it show me what? Like negative 2.5 billion for the last 12 months of 2024, which is so that's trailing 12 months, I guess. There, it looks like their annual year ends in June or something. So but that's on revenue of going up towards 20 billion to almost 21 billion over that time period. So in other words here, you're counting on that free cash flow figure changing drastically and going to positive and then shooting up from there, but firmly negative, whereas it was positive in 2023, 626 million, but firmly negative. So I don't follow them very closely. Maybe in the last call they were like, oh, for sure we're turning the corner on that, but that's definitely something you want to consider there. I saw a question there. I'll probably talk too much about Deckers Outdoor over the past couple of times I've been on. Tariff environment for Deckers Outdoor. It is tough to figure out for me to figure out like what proportion of their shoes are made where. Deckers, like the Hokas on my shelf that are sitting in there, were made in Vietnam. Which for the time being supposedly means they're not getting hit with tariffs. But I've been reading a lot of calls lately, so I'll spin out from this a little bit. And I see a lot of confidence among CEOs like, oh, we're fine because we moved so much of our supply chain out of China. And what they mean is it's now in places like Indonesia and Vietnam and other places over there. And as soon as somebody points in that direction and says, hey, why don't we put tariff on them too? Like, all of that work is undone, or all of that work, they all talk about it in terms of supply chain resiliency, but really they were trying to get out of the country most likely to be hit with tariffs. I wouldn't be so assured that those other countries wouldn't also be hit with tariffs. So we are at a time right now where it's impossible to predict what's going to happen because there's not a lot of predictability in who's getting hit with tariffs, or why, or at what level, and for how long. So,
yeah, it is definitely, I think tariffs broadly, everything we say, Seth, is speculation. And I think we all try to create like ideas about how things could play out and potential implications. I think it's a useful thought exercise, but it's not, I don't know how actionable it is, I think is the big thing. Because we've already seen here, 6 weeks in, with President Trump, things can change incredibly quickly, and we don't know how protracted or even in effect tariffs are going to prove to be, broadly, especially with our border neighbors to the north and south. So I think we have to be careful, like just contextualizing any idea of the impact. I do know that the story I've heard from the conference calls and the guidance that I've seen from retail companies is very muted. They're very, we see consumers already being thoughtful and pulling back. And these are the companies that tend to have some of the lowest net margins already. And maybe pushed to kind of soak up some of that tariff. But the thing to remember, Seth, I'll use your Hokas as an example. Let's say you have a pair of Hokas that are $200. And let's say
that's what the run of the mill ones are starting to cost.
they are, right. And let's say they were made in Canada, which they're not. It's not a $50 tariff. It's not on the retail price. It's the cost, the economic cost. So what eventually arrives at the end buyer in the US is a different number, right? In terms of what that tariff would be, that would be added to the price that is paid from the manufacturer to the distributor, and then the distributor to the retailer, right? So the markup along the way, where the tariff happened at the border from the cost from the producer is different than where it arrives at the very end. So I think we have to remember that. But broadly, there are concerns about the economy, right? That consumers are starting to get squeezed, and that could affect the companies that are more on the discretionary end, particularly the ones that they're do most of their business with middle class and lower end earners that have less discretionary income, are the ones that their discretionary spending is going to get reduced the most. So on paper, that's what we know, but we don't know what's actually going to happen in the real
Yeah,
world,
we have
Seth.
no idea, unfortunately. And there's a
Yeah.
few other pieces of information that I would throw out there too. Last week, or was it last week? I saw a couple of news articles that were based on Moody's, based on, not based off of. Don't come to me with based off of, or my eyeballs will fall out of my head. Based on some Moody's research that said that half of the consumer spending in the United States was
top
done
10% earners
by 10% of people.
Top 10%. Yeah.
And so I honestly don't know where that leaves us in terms of trying to decide like what would tip us into a recession. Typically, a recession happens for if there's a big shock to something like the housing market, like there was, or the tech market, like in 2000. Those can lead to recessions. But like your average run-of-the-mill recession is just all of a sudden everyone decides, they get afraid and they think they shouldn't spend as much money, and then that fear builds and it kind of snowballs, and you get this protracted time of everybody like hunkering down. And so people have been concerned about prices for a long time, and I found one of the ironies of that everybody was complaining for months and months and months. Everyone was complaining that restaurants were too expensive, yet restaurants were just we're stuffed and we're reporting great comps and everything. Yeah. Restaurants, everyone was going to restaurants, paying those prices, and then complaining that they were too high. And of course, it was contributing a lot to inflation. But, so who was causing that inflation? The people going to the restaurants, right? And paying the prices. There was no pushback.
Right.
So make of it what you will. You might want to look at your portfolio and say to yourself, if 90% of the Americans and decide that they are going to buy fewer groceries or buy fewer like motorboats or whatever it is, does that have an effect enough to throw us in a recession? Or what happens if the 10% of people who are super rich and are spending half the money, what happens if they change their minds? Now they tend to spend on different kinds of things. Mm-hmm. Mm-hmm. So you might want to look at your portfolio and base some of your decision making on that as well. I mean, there's usually a trade down during tough times and during recessions. And so Walmart, ironically,
that's why they win.
Yeah, has done an okay job. Walmart's, at least a lot of the ones I've gone to, they no longer like make my ears and eyes bleed. Like Walmart has done a good job attracting higher income shoppers who are looking to save some money. And I will say for Walmart, they have some of the best produce. No matter where I am, as I drive across country, if we want to stop and get some food, we almost always stop at a Walmart now, because we can get great produce at great prices to eat in the car, like grapes and stuff. They do a really good job, and they've taken a big piece of the grocery business because of that.
Well, it's Walmart's, but that's what Walmart's story has always been about, being better than everybody else at logistics, getting goods in front of the people that want to buy them. And they've carried that over to their grocery business and done an excellent job.
Yeah. So if you have exposure in your portfolio to consumer facing stocks, retailers or staples or discretionaries, you can mull this stuff over and come to your own conclusions. I honestly don't have any to give, and I'm never shy in giving an opinion, but I had formulated a great one on all of this.
Yeah. The last thing I want to say about the implications of tariffs is the reality is that when it comes to a lot of these macro environments, it's so tempting to try to find some way to act to bolster your portfolio, avoid downside and that sort of thing. And we're almost always acting on some sort of short-term implications that rarely works out in the way that we think. We just have to, when you're investing in stocks, The long-term return is the goal. This is a tool to generate long-term returns, and you have to invest in the environment that you're in. Sure, when everything's expensive and valuations don't make sense and you can't find anything that makes sense for you to deploy new capital in, that doesn't mean that you have to hold your nose and just buy. That means you can just wait and continue to hold. Again, you mentioned geezers. That's a gap term, by the way. If you're a geezer and you have a lot of exposure to equities, you have an asset allocation problem, right? If you need more cash for the near term, that's when stock volatility to the downside is a risk for you, and you have the wrong asset mix to get through that. Stocks should still be the long-term creator of value. So I think that's an important thing to remember, is it's so easy to try to chase ways to bolster our portfolio in the short term. Time is really how we bolster our portfolios.
Yep. And it's all different. It all depends on what you have. Like, I tend to hold a lot of cash because, like I tell everyone, I can still remember when my wife and I were first married, 2 digits before the decimal point in the bank account. I can still remember that. So I invest differently than other people who had a lot of money and for whom, like, holding a stock that looks really expensive doesn't matter, because if it gets cut in half, it doesn't change their standard of living. For me, it might make a big difference. We invest differently. We all invest differently. Similarly, like, you don't have much cash for retirement, but you've got like a spare house or a cabin that you could sell in 3 weeks and generate cash. You'll make different investing decisions. Somebody else is going to be moving more as they get older, more into cash-like instruments to have that ready to go for retirement. Somebody else may not need to do that.
Yeah. I think, and I want to stress this, if you're looking at stocks and you're thinking about what they can do for you in the next couple of years, the next 5 years or less, whatever conclusion you come to is highly likely to be off and wrong, simply because it's so difficult to predict what stocks are going to do in the near term. I don't know if I can stress that enough. It's so hard to predict what they're going to do in the near term. So just be very careful about that. We got about 2 minutes left here. I see David Meier and Emily Flippen waiting in the wings. Seth, you see a question or two you want to hit before our time is done?
Oh, I see the Yeti question there. Yeti is one of those ones I missed when it got excited. I haven't checked on the stock for a while. One of my problems with Yeti, I guess I was too big into the details, is like, I have like a cheap Coleman cooler and it works just fine. And so like, if I need to go buy another bag of ice because it doesn't hold the ice twice as long, that's never been a problem for me. But apparently Yeti did great. But I'm surprised that Yeti sells so many goods in China, pretty expensive. Anecdotally, my wife loves the Yeti tumblers she's got. Of course, she's never paid for a single one. People have given them to her. So Yeti, I always like to say Yeti has been a stock that did things I didn't think it would do. But on the other hand, like, does everyone remember what a thermos was? Like, at some point, thermos was Yeti, right? Because clearly, like, thermos became the name for the thing, right? And just like Yeti became the name for the tumbler and the coolers now. So, sometimes those brands last forever. Sometimes they don't. All part of the fun and risk in investing.
Oh, that's exactly right. Well, let me take, I'm going to take Jimbo has a most recent question here. And this is kind of a mindset thing, but also thinking about building a portfolio and helping bolster yourself to get through these periods. The consumer has been pulling back for a while. Jimbo writes, it is not about tariffs. The economy is rolling down and now we have to deal with tariffs. What do you do? I think it gets back to what we always try to do as an investor and thinking about what are our short-term and long-term goals, medium-term goals, build a portfolio around those things. If there are assets you have invested in stocks that could, like you were talking about, that if you're in a situation where that stock falling 10 or 20 or 30% would meaningfully impact you in the real world in the near term, then it's probably a time to sell. Holding cash and predictable assets in the near term for near-term needs is so valuable. It's so valuable. But also holding cash as a tool to manage your own psychology inside your portfolio is really valuable. If holding 5 or 10% of your portfolio in cash, even if you're 35 and you're decades from needing that money, but if it keeps you from selling perfectly good stocks that are expensive today, but are still going to do great over the coming decades, because it gives you money that you can use if we do see a downturn, that's so valuable in terms of optimizing your portfolio for yourself.
Yeah. And I'll throw in one more thing. Say we got one of those scary downturns. Here's what I said all the time during the whole COVID downturn. I don't know if people even remember this because it turned into a crazy bull market so quickly. But back in the first few weeks when people thought that nothing would ever be worth anything again, I said, again, the cost of doing trades is literally zero for most of us. So you could buy a few shares of stuff you like a couple of times a week and get yourself into and kind of like make yourself numb to the risk that way, instead of saying like, instead of trying to pick the bottom and roll in big there. You don't have to do that. You can start the habit of investing when the times are scary, if they get scary a little bit at a time, because again, you're not going to get eaten alive by transaction costs.
Let me tell you how it can work out as we bring David and Emily to the screen here, to the show. If you bought the first week of October 2007, it would take you 5.5 years. If you bought an S&P 500 index fund, that last week, that first week of October 2007, it would have taken you 5.5 years, Seth, to get back to break even. That's one of the worst weeks to have bought in the past 30 years. But if that was just part of like your regular dollar cost averaging, that was the week you bought on your 401k and you did it every month and just, you didn't realize that you were exposed to it, so you didn't sell at the bottom. But if you bought that week, it's up 424%, 17 years later. That's about 10.5% annualized return, which is about the market's long-term average. So even the worst possible time to buy for a very long period of time, if you hold long enough and you own the right quality of business, it's probably going to work out. Your holding period, your time horizon is so important to maximizing these investments.
And sit on your hands more. And it's also okay. It's also okay not to look at your stocks every day. It's even okay. Oh, well, I get fired if I say this. It's even okay not to listen to us every day.
But we would rather you listen to us.
But you should probably listen to Emily and Dave more than you.
We should definitely listen to Emily.
Yeah. I don't know about that. We'll find out, I guess, in the next hour.
All right. So you guys have fun.
Yeah. Nice job, you two. And welcome to this hour of Fool24. I am David Meier here with my wonderful colleague, Emily Flippen. Emily, how are you?
Hey, doing well. How about yourself?
I also am doing well. And this is the first time that we're doing this together.
Yeah, I think we have a couple hours actually coming up here in the next few weeks if we're lucky.
Yes, and I'm excited about all of them. All right, so I was listening in to what Seth said about Yeti and Thermos, and I'm sorry, but I have to start with a little joke. It's an engineering joke. It's a nerdy joke, but
okay,
I think you and I hope everyone else will appreciate it. So there's an old engineering joke that goes, "What's the greatest thing that's ever been invented?" And someone said, well, the airplane. I mean, how do you get those big things to fly? I'm like, nah, that's not it. And someone says, it's the human body, right? Or like, look at all the things that it can do. It's got electrical impulses. It's got mechanical levers.
I can think of a lot of ways to improve that, actually.
And then someone, and you pick your best rival college here and say, this engineer from such and such a college says, it's the thermos. It keeps the hot stuff hot and the cold stuff cold. How do it know?
It's funny that they ended that hour talking about Yeti, though, Dave, because I don't know. I don't think we were on the same team when this company went public. Because I think it was back in 2018, I want to say.
Yeah, well, I wasn't on the publishing side back then.
I hated this company. And I haven't followed it mostly because I'm not that self-loathing, right? I look at this company and I look how well it's done and I kick myself a little bit, but I hated Yeti when they went public because it was one of those companies that was spun out by a private equity firm. The two co-founders who had been running the company were effectively using the IPO as a method of selling out of their business entirely. And they were still pretty young at the time. There were about 1,000,001 knockoff brands, and all of my research into the product itself basically said, it kept the cold stuff cold and the warm stuff warm, but there were about 1 million different products that also kept the cold stuff cold and the warm stuff warm. at an equally effective method for half the price.
Correct.
But man, did I really underestimate how much people would really love and associate with the brand. And even to this day, I remember, I can't tell somebody that, hey, that Yeti thermos works just as well as the $20 one at Walmart. They're like, no, but you don't understand. I have ice in that. I'll sit there for 24 hours and there'll still be ice. And I'm like, yes, I know. But they love it. They really do.
It is amazing how that quickly became a status symbol brand. It
really
really did. And it's hard to predict those things, right? I mean, we're fortunate in that we get to maybe see it more often from a investing standpoint, but it's hard to predict like what's going to hit and what's not. And man, Yeti just hit.
And I knew I had immediately made a mistake because they went public. I remember I had all this research on them, decided I didn't like them, and I went back to Texas for Christmas, and everyone and their dog got a Yeti for Christmas that year. And I remember being like, crap.
But that's okay. That's okay. We all
as long as we learn and move forward.
Right. And we always make errors of omission. Like you and I, our portfolios are not littered with things that we should have bought. But at the same time, there are things that we didn't buy that turned out to be the right decision. And that's the beauty of the game, right? That it's one you get to play over and over and over and over again. So
yeah, that's the best part.
We don't have any specific topic. There's been some lot going on and from an earnings standpoint. So this is really ask us anything. And I see that there's definitely a bunch of questions that have poured in. Do you want to kick us off?
Yeah, there's already so many great questions. This is wonderful. I say we just start from most recent and work our way down. Does that sound good?
That sounds good.
I see first question here. And of course, this is a challenging question. I saw it initially, so I've had a little bit of time to think about it. I'm happy to go first if you want some time to marinate. But AB Fool asks both of us if we have high conviction picks for 10 baggers over the next 5 years. And I just want to kick off by saying, I mean, a 10 bagger over 5 years, that would
that's pretty good.
I think we're getting into penny stock territory with that type of ask. I don't spend a lot of my time looking for that type of return, mostly because it's virtually impossible to predict on such a short time frame. Now, there can be great companies that return that over a short, 5 years for a 10 bagger is pretty incredible. And there have been amazing businesses that have done it. I'm trying to think I don't know if any of a short time period, I'm sure Netflixes of the world have, but I can go for it.
But I think there's actually one thing that's extremely important. So let's talk about the process by which this could happen, right?
Yes.
You're going to have a very good business that something has happened, right? There is something going on, whether it's in the macro environment or whether there was a stumble or something that has knocked the price down significantly to get 10x return in a 5-year time frame. Now, I actually have a story about this that I can tell really quickly. And the company is AES. It's an independent power producer. Ticker symbol is AES. It's actually based in Arlington, Virginia. I came from the power generation industry. I was an engineer beforehand. And this was in the very early 2000s, like from 2000 to 2002. There was a bubble in power generation. All the stocks at the time were just massively inflated. And then the bubble burst. And guess what happened to all those stocks? They collapsed. I mean, literally collapsed, down between 85 and 95% type of collapses. So that's one thing you have to have. There has to be some event that has happened. Well, when I looked at AES, again, being in the power generation industry, I looked at it and I was like, this company's still got plants. It's still making power. Yes, it's not growing as fast as it once was, but it's basically selling below its liquidation value. And the other thing was the company couldn't go bankrupt. All the debt that they had to build these plants over the past 20 years, right? All the growth that they had, they were recourse to the plant itself. So if there was a problem with a plant, essentially they would turn the keys to the plant over to the bank, so to speak, rather than the whole company goes bankrupt. And yet the market was pricing this as this whole company is going bankrupt. I'm like, that's an impossibility. And I just watched the stock go down, go down, go down. I bought at $4. I bought at $2. I bought at $1.15. And then in about 5 years, I had a 12 bagger. I mean, but again, you have to have, there has to be some sort of big set of circumstances that has happened to get a stock to go down that far and then rebound that much. So it's not an easy thing to do.
Well, I think that's one of the ways that you can get a 10 bagger.
Yeah.
I think the other way is that there's some sort of paradigm shift happening, like something
Well
crazy is
said.
happening for a business that results in unforeseeable, or I shouldn't say unforeseeable, but tailwinds that the market has not priced in today. And that's the riskiness that I think comes in, the risk reward with these types of investments, because typically that's associated with a company that either 10 bags or it goes to nothing, right? Because that paradigm shift either happens or it just doesn't manifest. I think the one that comes to mind probably most readily to me, and I don't like to think that this is completely binary the way that like a pharmaceutical or an early stage pharmaceutical company is completely binary if it's dependent on a single drug, but a recent stock advisor recommendation in Pure Storage. So this is a business that is really trying to get a bunch of hyperscalers, so think about the Metas, the Amazons, the data centers of the world, to switch from more traditional hard drive or solid state drives to flash-based memory storage. Now, their leadership team really believes that this transition is going to happen over something like a 5 to 10 year period. It's probably an aggressive assumption that all of the data centers of the world, all of the hyperscalers are going to be moving towards what is effectively Pure Storage's proprietary flash memory-based solution. But if that happens, you can see how this, I think it's around a $15-ish billion business today, could result in $100+ billion business over whatever time horizon that ends up being. 5 years, it's aggressive, but that's kind of an example of like, that would be a paradigm shift for that company. Now shares are not, unfortunately, down significantly. I think they've fallen just a bit. They've pulled back from previous highs, but the market is expecting that there's some people who are certainly betting on that paradigm shift potentially happening. There are some people betting against it, which is why there's not $100 billion plus business today. But I think that is an example of one that comes to mind of like, I know when we made that investment in Stock Advisor, that recommendation in Stock Advisor, it was kind of like this either happens or it doesn't happen. And that's where you get those potential 10 baggers.
Well said.
And I'll throw another one just
Sure.
because I can. And I'm killing some time here, sorry, with this question. But I love that. And unfortunately, I wish I had some more of the ones that you mentioned, Dave, around great stocks that have pulled back a lot. And maybe some will come to me a bit later. But one that I know that we've talked about in the past, a business like Dutch Bros. Now, this 5 years, I think, is being, again, a bit generous, but this is around a $10 billion business today. They're a coffee drive-through chain. Shares are certainly expensive. But I look at, again, the Starbucks of the world, $100+ billion company. Should they expand their store count to where they expect they can be over the course of the next 5 to 10 years, which is 4,000+ locations. And that's just domestically, not even thinking about the international potential with their business.
Right.
You could see how that could potentially be $100 billion plus business. So when I think about those 10 baggers, I think of, okay, I tend to think in market cap. That's not the only way to think about returns. Obviously, there's lots of ways that shareholders can get return that isn't just pure capital gains or I shouldn't say just pure market cap expansion, but $10 billion company today. What does it take for that to be a $100 billion company 5 years from now? I can see that future for Dutch Bros, but it is risky. And that's kind of the risk reward you get with those types of investments.
Yeah, the company's certainly has been performing well since you recommended the stock. So that's awesome.
Yeah, I mean, I think a lot of that has to do with management sandbagging with guidance here. And I think there's competition that has become incredibly stiff. Actually, a viewer here on Fool24 brought to my attention a competitor on the East Coast called Brew7, I believe. And apologies if I got that name wrong. And yeah, have we talked about it before? But it is.
No, but I have one of those around the corner from me.
Yes. And because you're in South Carolina, correct?
That's correct.
And that actually, I hate to call it a knockoff, but I think that's a fairly accurate description. I believe it was started actually by a former Dutch Pro employee who effectively took the business model and started off the East Coast and is expanding westward. They're meeting here in the middle, like Tennessee. But yeah, it's pretty easy business model to replicate. I don't know if there is a lot of brand loyalty there, the way there is with the Yetis of the world. That's a risk for Dutch Bros. That prevents them from getting 4,000 store locations when you're already getting your coffee at 7 Brew, right? In South Carolina, they're already there. They already have loyal customers. That could hurt them.
Yep. No, it's a very good point. Competition is always there and always trying to steal your customers.
Just means there's good opportunity though.
Yep. All right. What do we got next? What do you see that's interesting next?
Awesome. Let's see here. I see a question for me at least asking, how do I feel about Cart and Wing? That's Instacart and Wingstop at their current price in terms of risks and rewards. Both of those businesses are ones that I am a fan of, not to let the cart lead the horse here.
Yeah.
But both great businesses, both have pulled back a bit. Wingstop a bit more than Instacart. So I actually think Wingstop, in my opinion, is a little bit more of a timely opportunity. But both had quarters that disappointed the market. In the case of Instacart, this was kind of your classic strong quarter. Business is still very much on track here, but guidance didn't quite meet expectations. Sales growth didn't quite meet expectations. And in the environment that we're operating in, and for the listeners that stuck around for the previous hour or sticking around now from the previous hour, we just talked about a weakening consumer. You can see how Instacart's business can tend to kind of ebb and flow with that consumer spending. I think there's just a lot of understandable market skepticism around some of the near-term headwinds facing that business. That is largely what's kind of, I think, causing some of that pullback in Instacart's response here. So I think that has a lot less to do with any core faults in what we're seeing from Instacart in terms of the numbers they're putting up, and more just broad market hesitation. Wingstop is a little bit of a different story. Wingstop is coming down after years and years of incredible, like 20 to 30+% same store sales growth, incredible market expansion, double-digit expansion in their actual shop locations, a lot of that being international. And they came out with their quarterly results, knocked it out of the park. Quarterly results were incredible in their fourth quarter. But then management comes out and says, hey, for the remainder of fiscal year 2025, we actually expect we're going to have mid to low single-digit same store sales growth. And the market was like, whoa, what are you talking about? Yeah.
You can't do that. You've been growing much faster than that.
And the context wasn't really there either. It was management didn't really provide a lot of explanation as to what this sudden slowdown was. Of course, there's obviously some headwinds there with the price of bone-in wings.
Yep.
But that doesn't impact same-store sales growth, right? That's okay. I can understand if your margin is going to, which I did guide for slightly lower margins. And, you can understand a little bit there. They've always had to deal with the commodity prices at Wingstop. But what's happening with the consumer at Wingstop that would cause such a change over the period of one quarter? Now, this could be like Dutch Bros management team where they're like, might as well be conservative and then pleasantly surprised. But it makes you wonder what leadership is seeing that investors aren't seeing yet in the behavior of consumers. And I wonder if some of that comes down to just sheer competition, or if the stores that they have built out over the course of the last couple of years are just not as effective or only cannibalizing the stores that they have. And they do operate under a franchise model for anybody who is unfamiliar with that. So I think there are some understandable question marks there, but the pullback I think is just so dramatic that it offers a little bit more timeliness in comparison to the Instacarts of the world.
I think you bring up some incredible points. The only thing that I would add is I think Instacart's business model is a little more challenging given it's a little more complex, right? They have to manage on the employee side. There's more complexity there. How do I make sure my orders are correct? There's a little more room for error in terms of not delighting customers, right? There's more potential for error. So I think I somewhat agree when you say, with Wingstop's model being a little more simpler, right? Even though they probably already have all the great locations that they wanted, right? Those get built early. It's a simpler model to deal with. And that's also why it trades at a little bit of a premium of evaluation relative to many of its competitors. But yes, the pullbacks are both very interesting on these businesses because one, Wingstop just is a good business. Like it just, my goodness, it mints cash. And Instacart, I think, is serving a need that continues to grow. So we'll see what happens over time.
I love that because it segues into a question here that we have from Jimbo, who says, cart or dash, which one would you prefer to hold and why? That is
another good question.
Yeah, comparing Instacart and DoorDash. And you mentioned there, Dave, about some of the complexities that I think you're right to point out do exist with Instacart's model, some of which you would argue could pull over into DoorDash's business model too. Both of these are stock advisor recommendations. I have thoughts a bit on both, but I'm going to hold them back here because I've shared my. Do you have any thoughts additional? And if not, I'm happy to chime in, but I want to give you the chance to chat first.
So the first thing that comes to my mind when I see these two tickers is DoorDash is one, a little more mature, right? They have solved a number of these problems already. Two, DoorDash is looking to basically take its technology stack and its infrastructure, right? All the delivery infrastructure that it's created, and it's looking to expand. Whereas, and you can correct me if I'm wrong here, but Instacart is really focused on the shopper for right now. And so they're at different points in their life cycle, and DoorDash has really, and getting back to the errors of omission, right? This is one where I was like, I don't really see this. I don't understand this. There's lots of competition. There's more coming, right? And all this stuff. But DoorDash has really done a great job of building a business that, in my opinion, has sort of beaten the odds in terms of being successful. So I admit I don't know the DoorDash valuation off the top of my head, so I can't make a comment there. But from a business standpoint, I think DoorDash is a little more mature, a little more. I think I'll just stick with mature, but doing a good job of taking what it has and trying to expand it to new markets at this point in its life cycle.
Yeah, I think that is a completely fair assessment. DoorDash, I'm going to pull it up really fast here because I don't want to get my facts wrong. Yeah, $80 billion market cap. I think people can forget how large of a company DoorDash is when you think about it as just an app. Now, Cart is not exactly small. Yeah, $10 billion. So yeah. I do think it is a fair assessment to say that DoorDash is more established from adoption perspective, and they certainly have the larger audience. That being said, one of the things that I think investors often think when they hear that market cap difference between the DoorDash and Instacarts of the world is like, okay, well, DoorDash is the larger company, so therefore it's more established, it's safer. Instacart, it's more profitable. DoorDash just recently became profitable. Instacart produces 3 to 4 times as much profit and cash flow as DoorDash does. So while I think Instacart has more challenges when it comes to its fundamental business, right? It has a larger competition, a lower rate of adoption, and it's growing slower, significantly slower in comparison to DoorDash, which explains, again, some of the differences in valuation there. I do think it's the business that it does have is just fundamentally and systematically more profitable. The business that they've built, especially when it comes to white labeling their pickup and delivery options, it's just incredibly profitable for the companies that they've integrated with. And yep. It's really hard for those businesses to effectively come in and replace. So I think if I was a business like Walmart, that was my reckless prediction for 2025. If I was a business like Walmart, I actually think Instacart's kind of eating their lunch here in terms of white labeling their own back-end solutions. I'd be interested, while Instacart is still at a sub $10 billion valuation, at potentially making an acquisition here.
Whoa.
Well, while we have a potentially looser regulatory regime, now I could just potentially be making a wrong assumption. I know that right now regulators actually haven't changed any policies under the new administration in comparison to the previous one. But I think there's a going assumption, especially with all focus in the federal government being elsewhere, that it's probably not a top priority. Anyway, so if I was Walmart, I'd be looking at it. But I like both these companies. And to your point, Dave, DoorDash is certainly one that I have slept on. I think there was a lot of skepticism as the Grubhub, kind of debacle happened, but I lumped DoorDash in there with them, and they're certainly a different business. The last thing I'll quickly note on Instacart, though, because I do think, again, it's so important to note because it's easy to forget how profitable Instacart is. They had a stock-based compensation charge associated with their IPO that initially made them look really unprofitable. That has now since lapsed, of course, so that you can see the GAAP profits now, but the cash flow is a great story there. Is a reminder that their advertising business, kind of similar to Amazon with their listing, that is just starting to take off for them. The growth was pretty slow last quarter. I think it was around 10%. And unfortunately, management's guiding for that to slow down a bit. And I think that was contributing to some of the sell-off that we saw in the previous quarter. But similarly to how brands pay for shelf space in grocery stores, brands that are on the platform pay for shelf space or view space,
Yes.
I guess, in the Instacart app.
Digital shelf space. Totally
And
agree.
that should be, again, guidance is a little soft there, so big question mark, but that should be high margin revenue for Instacart long term.
Absolutely. I mean, they have, right? If you have the eyeballs and you have the data about what people are buying, right? You can share that with the people who want to be on your platform, the suppliers, and make it worth their while, right? So perhaps they have a few bugs to continue to work out, right? But I think that is absolutely the right direction for that company to be moving in. And I agree, that's extremely high margin revenue when they
Well,
get that
again,
thing
it
growing.
should be. I don't know why they're guiding for it to. Their adjusted EBITDA guidance for the advertising business was soft next quarter, and I think there's a lot of companies have kind of guided for this to be soft. I mean, the Trade Desk itself is example A after
Right.
the previous quarter. So there could just be some tepidness that I think all management teams are taking right now to be like, hey, just in case we're being conservative with guidance, and maybe next quarter will be better. But for one reason or another, that just didn't quite meet the market's expectations.
So, on to the next question. There's one directly from me, for me, and that is, you mentioned some knowledge of Align Technology, ALGN. Is this a company that has a long runway of sustainable growth? Price valuation has slowly come down, and that's from Sasha B. Thank you for that question. Real quick, if you don't know Align, it is the maker of Invisalign, which is the braceless braces, basically moving your teeth around. I've known about this company for quite a while. I learned about it from our colleague Charlie Travers. He and my daughter is a dentist studying to be an oral surgeon. Her husband is also a dentist, so we have a little experience here. My wife has used the product. It's actually a pretty amazing technology platform. So they know a lot about the science of moving teeth, and especially like difficult cases, like to snap, if your teeth aren't that bad, right, you can snap in an aligner, and the science, we'll call it, is pretty straightforward. But if you if you have serious crowding or something like that, they can even still handle that from an insert perspective. So they basically know the science, they know how to take images of it, and they know how to develop treatment plans or work with the dentist to develop treatment plans to get your teeth where they need to be, just by a gradual shift in the design of the aligner that you're putting in your mouth. And they do it all, they 3D print it, and so it is an amazing business, and they went through massive growth, and now it's a mature company. The growth is still there, but it's not at the 20+% that it was, back in the late teens, 20 teens, and in early 20s. I think it's actually started slowing down after that. But we're at maybe 3 to 7% type growth. So I don't, sometimes that might not be exciting for the market or market participants, if you will. Let me check something really quick here, but they still seem to have very good margin structure. They do generate a considerable amount of cash flow. Their investments are more in the maintenance mode as opposed to growth mode, in terms of the machines that they need to invest in, the capex that they need to make. So there's a little more free cash flow that it becomes available. But I don't know. At this point, I haven't looked at the company in a while to really make a longer term assessment. But I've always been impressed with the business. It's certainly, from a valuation metric standpoint, it's cheaper than, or it's less expensive than it has been in a while. But at the same time, you are dealing with a slower growth company. So that's how I would think about the investment, without making a recommendation, because I haven't really looked at it closely in a while.
I unfortunately don't follow them, but I do know that every single time I go to the dentist, my dentist tells me that I need to get them. And at some point I may actually bite the bullet.
And do you know, not only do you know, but not only may you need them, like I don't know for sure, but do you know why? Because
I know they get kickbacks.
correct. They've made it worth. They've given an incentive to the dentist to, to sell their product. And again, there's nothing wrong with that, right? That's the whole point of understanding that this company is technologically sound. This is why dentists want to partner with them, because it helps bring revenue to their practices, helps bring margin to their practices, but at the same time, it has served aligned shareholders well as well.
Definitely. Great thoughts. Okay, I have a question here from, let's see, Jimbo, who says the assumption is that tariffs, and apologies for the tariffs, we'll keep it light. I know everybody is probably, but the assumption is that tariffs will not be here for the long term. Do we really know that? It does not feel like COVID-19 was a short-term thing. And I know that the tariffs are an incredibly hot topic. And, I mentioned this to you, Dave, I got on, but about to take the Stock Advisor podcast here when you get off. And of course, the first thing we're going to be talking about for the Stock Advisor podcast is tariffs. From my perspective, what is my perspective on whether or not these will be long-term?
I can give you mine.
Okay, go ahead and give me yours. I have perspective. I don't know if I have an answer for whether or not they'll be long or short term, but I don't know if my answer actually matters, to be frank.
We have no idea.
Yeah.
We literally have no idea.
And that's the problem.
The other day, right? The tariffs are starting at midnight on March 4th. Right?
Which I guess was
Tuesday night or Tuesday morning. Today, the headline I have the Bloomberg television show in the background. 2 hours ago, the headline was auto tariffs for Mexico and Canada. Being considered that they delay them for a month. We have no idea. None. We do know what tariffs will bring, though. Tariffs are paid by the country where the goods are flowing to, the people who import the goods. So either if a product is, let's say a car comes from abroad and comes into the United States, whoever brought that car to the United States is paying the tariff. Whether or not that gets passed along fully or partially, or maybe none at all, depends on the state of the business who's bringing it in. So that we know it's a tax. It's an import tax. That's what it is. It will be borne by wherever the country wherever the import is going. But we really just don't know if it's going to be long-term or not, because we don't know what the purpose of these tariffs are. It's not been articulated well, in my opinion. So I don't know how to answer this question. I really don't. And you can see the market has not liked this.
Yeah, I think what the market is reacting to is the uncertainty.
Yes.
I think that's what the market doesn't like is think about the perspectives of the businesses that are trying to make import and export decisions.
Exactly.
Without having an idea about what your products, ingredients, whatever it is that you're sourcing are going to cost, it's really hard to make long-term or longer, even medium, short-term business decisions.
Correct.
And, the uncertainty there is what the market's reacting to. And my silly speculation here is that if we had a strategy that had been communicated, right, saying, okay, 3 months from now, these are the things that are going to be subject to a tariff. Here's the exact rates. Here's how long it's going to last. Here's the certainty, right, that's around it. And here's how other companies are going to respond. Like if we all knew 100% certainty, here are the facts, and we knew exactly what was going to happen, then businesses could respond appropriately. We probably wouldn't see the volatility that we saw in the markets over the course of this week so far. But it's the uncertainty of how long are these tariffs going to stick around? What's actually going to be impacted? How are other countries going to respond? Will they, change? Like,
yes.
Will it escalate further? That's leading to the reaction. So I think it's kind of like less of a, is it short? Is it long? It's more of just like what's going on? And the fact that nobody can answer that question is what's leading to the short-term sell-off and then the bounce back and then the sell-off again. And
yes.
That's the benefit of being a long-term investor is, so what do we do, right, in this situation? And oftentimes the best thing to do is probably, ironically sitting here talking about it, is to probably do nothing. Don't pay attention to the news. Don't pay attention to what your stock is doing on a day-to-day basis. And if it helps to sit here and talk about it, that's great. You know, it helps me. I'm a verbal processor to talk about it, get it off my chest. But the end result is to do nothing. Because if we're trying to time those types of decisions with this amount of uncertainty in the market, that is a losing game.
Yeah, and I think the other thing that we can do as investors is you can take a look. We can take a look at the stocks that we own and see, okay, like is which group of them could be impacted the most by tariffs. Like, you know, one of the things that I've been thinking about recently is you know, like software businesses probably somewhat immune from this right now. Now, they could be affected by if they have to buy hardware, right? If they have their own data centers, they need to buy hardware. There could be ancillary things like that. But like their product is not being subject, as at least what I've read and what I think I know, their product is not being subjected to these tariffs. So there won't be any, you know, decisions that do I change my pricing? Do I eat the margin? Like, what do I do? But for a lot of other businesses, right? Some businesses said, I don't know what these tariffs, I don't know what's going to be taxed or, you know, what's going to get an import tax. I'm just actually going to load up on inventory that I know I need, right? So some said, I'm just going to buy early. Some have come out and said, you know, we'll just see. Some have tried to, you know, some have tried to hedge, right? So there are markets where they can hedge their buying. But you put it perfectly. Some businesses like, we just don't know what to do. So make sure your portfolio, you know, we can make sure our portfolio is full of, you know, strong businesses that are, you know, can weather some of these storms. And, you know, we think have prospects that are really, really good looking 5 to 10 years out.
Definitely.
A good question.
Okay, I see a couple of questions here. Sorry for dominating, Dave. Actually,
No,
you
no.
go ahead. If you have any that you want to take.
I was going to say I haven't looked, but here's here's one that I was expecting, and I hope I pronounced this person's name right. Vihan says Fluent Energy takeaways from current earnings valuation 10 bag from here in 5 years? Question mark. That's definitely a potential. So for those that might not be familiar, I can quickly tell Fluence Energy is a stock rec that I have in the trends service. It unfortunately had a poor earnings report. It was 2 contracts that it was looking to fulfill had to get pushed into 2026 because they weren't going to fulfill them, and they weren't going to be able to book any revenue in 2025 as a result. So guidance was brought way down. According to management, the contracts, they didn't lose them. It's not, but they weren't able to execute them. Unfortunately, the stock has taken a big hit. What is happening, right, is the market for clean energy. There's some worry that it's going to continue, that there could be a slowdown given the new administration. The demand still seems to be there because not only is Fluence Energy in this business, but Tesla has an energy generation and storage segment that is still growing very rapidly. The company Fluence is still expected to grow at about 20% for the full year in 2025. So it's the amount of growth that has changed. The company in 2023 and 2024 did a good job of rejigging their cost structure such that now their contracts produce margin, their contracts produce cash flow. So the business has gotten stronger. The demand, we think, is still there, but there might be some uncertainty. And this is a management team that, quite frankly, is not a growth at all costs management team as the ones they replaced. This is a more prudent, we want to make sure that we serve shareholders type of management team. So I won't go out and say I'm definitely not going to commit to a 10 bagger in 5 years. And I will say there's still, this is going to be a stock that will not see investor sentiment change until the management team starts reporting improvements in the performance. So it's going to take a little bit of time before investor sentiment changes, but it seems to be priced, in my opinion, rather attractively relative to its prospects. And it has a relatively strong balance sheet that should help it weather the storm. So thank you for that question. Unfortunately, it is one that has fallen pretty hard, but I'm not recommending, I'm not just saying that we should, sell it in the service, because I think the stock is pretty attractive today.
And with a lot of these types of companies, we're going to see realities where they fall
That's
pretty
correct.
dramatically. And typically that's so important to reevaluate when you have your thesis with these companies in the first place, right? Like, what is actually an actual thesis that has been broken versus what is business volatility here? And not to say that challenges can't exist that cause you to reevaluate your thesis. But yeah, I think it's important not to be reactionary with the stock just because it has fallen.
And I will say it's always important to test your thesis almost no matter what.
Yes.
Like we should be, as analysts, that's one of the things that we do constantly is, what has changed? Has it changed for the positive? Has it changed for the negative? Because, things may not change quickly on a quarter by quarter basis, right? When we get new information about how a company is performing, but those little steps can add up. So we need to, we always need to be at least monitoring the situation. So that's a very good point. All right. Did you get one? Did you get one that you'd like to answer next?
Oh, of course. There's actually two questions kind of in the same vein from the same asker here. So Ed is asking about ELF. It asks, initially, is it time to double down on ELF? And then asks Chewy or ELF, which is the better stock for long and short-term value? So I'll talk a little bit about ELF in general, then do a comparison here to Chewy. So both of these businesses are ones that I like. Now, ELF has seen a lot more share price compression recently than Chewy has. Chewy's been a bit flat, no real business challenges here, but also nothing incredibly exciting going on with their business either. They've had a healthcare initiative that has been pretty successful, expanding their margin, but nothing incredible, crazy, nothing like the 10x potential of some of the businesses we've been talking about. ELF, on the other hand, has had a little bit of a perfect storm here that has led to some share price compression in the interim. So if I'm looking at both of these businesses from the perspective of immediate value, honestly, both over the short term and the long term, from a value perspective, I'd probably lean in the side of ELF. Now, that doesn't mean that ELF is a better business. I think that ELF has a much higher risk profile, a much higher return profile. I think Chewy is, obviously more profitable, probably a more stable business, lots of different aspects that would lead an investor to potentially choose Chewy over ELF. But within the context of ELF, there's a lot of headwinds that have led to a share price sell-off. And for investors who are willing to take on the risks associated with these headwinds, I do think the long-term value is still very much there. So for anybody who's unaware, what are these headwinds for ELF? Obviously, tariffs are a big one. ELF is a discount makeup and skincare brand. And being a discount brand, that means they produce their products in the cheapest way possible. That means all of their sourcing comes out of China, and it has been for a very long time. I think it's 80+% Chinese manufactured. And I don't know if they intend on changing that. They've had some source changes out of there over the last few years. But for the most part, the Chinese tariffs that have been implemented and are likely to continue to be implemented are going to impact the pricing and availability of their products. I still expect their products will be cheaper than a lot of their competitors. They are significantly cheaper. They're the knockoff brand. Now, but the issue is that as that price just comes up, even just a little bit, they are getting closer and closer. And that can degrade a little bit of the pricing power that they have, or I shouldn't call it pricing power really, but just the perception of value there can be eroded a bit. And then, so there are obviously the tariffs. They also are the number one brand and main distribution channel through a business like Target. Target has had softer foot traffic. The entire beauty industry has actually seen a decline over the last couple of months. So in the most recent quarter, the entire beauty industry declined around 5 to 6%. Now, the good thing about ELF is they saw market share gains. They did not. But with the beauty industry declining, they continue to see slowing growth over the most recent quarter. Slowing growth equals decline in valuation, even as they're gaining market share in the entire beauty category and skincare category. And then lastly, one of their main avenues for marketing is through social media, TikTok mainly. And the TikTok pan that we saw happen over the previous quarter, even though it wasn't down for very long, barely at all, it just distracted from the beauty industry, right? People are talking about different things. All eyes are really on politics right now. So people's desire to spend and talk about skincare just lower than what it was before. And a lot of that is they don't spend a ton of money on marketing in that avenue. A lot of it is very word of mouth, very natural, I guess. And so with people's eyes and focus elsewhere, they just didn't see the pickup that they had, especially on a year-over-year basis, where they had a lot of really strong launches in the 2024 period. So they had a lot of headwinds that were impacting them this quarter. Their guidance for next quarter, as a result, was just pretty weak. We're talking about a business that is doing 30+% sales growth. So they did 30+% sales growth last quarter. In the next quarter, their implied guidance was around -1 to 2% sales growth. That's 1 quarter change. I think they're going to do better than that. I think this is management just being very, very cautious because, again, we're operating in a weird environment and everybody's like a chicken running around with their head cut off. But when you go from we did 30% sales growth in the third quarter to we're going to end the year in the fourth quarter with -1 to 2% sales growth, it's kind of like, oh gosh, the sky is falling.
Right.
So I think that's what we're seeing with Elf. I think they do better, but in the interim, there's a lot of headwinds here.
Yeah, I think you summed that up. Very well. Not one I follow. I know basically about the business, but yeah, it's been a challenge for them, and we're going to learn. It's actually a little. It's a tough lesson, right? But we're going to learn if this is as good a business as we think it is, right? Once they navigate this, see how they navigate this spell.
Exactly.
I would like to say thank you to Luella, Emily, and David. Love the way you answer the question, giving various ways to think about the situation instead of just fact regurgitation. We appreciate that. Emily is definitely one of the smartest colleagues that I have, and I could listen to her all day.
Dave is too nice. Right back at you.
All right. Let's see what else we got.
I see a question here from Ed about Upstart that I'm happy to take.
Okay.
Ed asks, in a month, Upstart has moved from $88 to below $60. Do you think it is a buy at this level? Or are there issues besides interest rates? This is a great question. And Upstart is an incredibly volatile business. I think prior to that decline from 88 to 60, which I'm taking your word there, Ed, because I'm not too familiar with where its share is today. But I think that had a pretty stellar, I believe it was their fourth quarter earnings report. Shares were up something like 20 to 30% on the back of that earnings report before declining. So this is a historically volatile company. And as you rightly mentioned, interest rates are a big part of the story. For anybody's unfamiliar, Upstart is kind of an AI-based lender. They're trying to disrupt traditional methods of lending by creating a platform that uses other factors to determine creditworthiness and give out loans to people. These started off as just personal loans, but they've expanded into auto loans, home equity lines of credit, small loans. They're expanding virtually anywhere that they can. And interest rates are a big part of that. As interest rates come down, obviously loans become more accessible, more affordable. Interest rates go up and people are arguably less willing to loan out. So those loans become a bit riskier, a bit more expensive. So interest rates are a big part of that story for Upstart, but Upstart has also had their own internal story going on. For anybody who followed this company over the last few years, they had a challenge as interest rates suddenly rose coming out of the pandemic unexpectedly. They had a big uptick in their underwriting. So they're giving out a bunch of loans to consumers, but they weren't able to move those loans off of their own books. So there's an argument from investors that Upstart was effectively acting like a bank because they were keeping these loans on their own book. And they have worked a bit to change that. They've increased the number of third-party partners they've had, and they started to launch these co-investing accounts. They still obtain a fair bit of risk. It's a balanced risk now with these third parties, but they still have a certain amount of high-end exposure for the loans that they aren't able to securitize and sell off of their own books. So for investors, I think that are comfortable and willing to view Upstart as both a platform for lending, but also potentially a bank, Upstart's performance has actually been pretty stellar. They've had a really decent turnaround in their business over the last few quarters. Their loans have consistently underperformed their own internal underwriting expectations over the high interest rate period. But in the last 2 quarters, that has recently turned around, implying that they're getting better at underwriting and gauging creditworthiness. There's a lot of tailwinds here that I think have shown management is on the right track. They're increasing the number of partners they have. And again, as interest rates normalize, and I don't think we're going to be in an environment where we see interest rates increase 4% overnight again, the way that they did over the last couple of years. That is all good, positive tailwinds for this company. But personally, I still think there's a huge element of risk that investors are still somewhat unaware of with this company. They obtain a massive amount of downside should these loans underperform. A majority of their loans are not securitized and sold off of their own books, and they obtain hundreds of millions of dollars worth of exposure that could be written off of their own books should these loans underperform, of which many of them have. And if you look at the loans that have been securitized and sold off, a lot of those loans have been, and again, in a high interest rate environment, so big caveat there, but a lot of those loans have seen their credit rating by independent credit rating bureaus been decreased over time because they haven't been paid back as readily as they were expected to when those were initially securitized and sold off. But the company is not actively going under. They almost reached GAAP profitability in the most recent quarter, so they're moving in the right direction. But I do think this is just an incredibly risky company. So if you're the type of investor that is comfortable with that risk, great, more power to you. But I think it's a risk that all investors should be aware of before making an investment in Upstart.
I think that's actually very well said. Risk is actually something we think about quite a bit. It's not, talking about risk doesn't sell, let's say, right? It's not exciting, but we have to be pragmatic here. We always have to understand there is no such thing as a riskless investment. Save maybe a treasury, right? But something catastrophic, literally catastrophic would have to happen in order for the US government not to pay that back. But we always have to think and do our best to quantify, but at a minimum qualify the risks that we're taking, because we're equity investors. We're not escaping risk. I think that's maybe an interesting segue into a question from Dakota Tim. Is there a macro environment that is more conducive for microcap, small cap companies to do well? Is now one of those times? That is actually a very interesting question, and one that I've been thinking about quite a bit, because for a long time, I was on the small cap bandwagon as this is a place where we should be looking for investment ideas. The broad reason being, as a whole, if I look at the S&P, the forward PE ratio of the S&P 500, the 500 largest companies, versus the S&P 600, which is high quality small cap companies, they have the PE ratio for the S&P 500 has been at 40 to 50% higher, and so that would say, at least from that perspective, maybe look at small caps as for stock ideas. From an environment standpoint, small cap companies, whether they're public or private, they need capital. If they want to grow, they need access to capital, and it can't be super expensive. I won't say we're in a super expensive time, but interest rates, were higher. And and trust me, they're not getting, with 10-year treasuries at 4.1 now or something like that. They're not getting loans at 4.1. Let me just tell you that. But equity capital for small caps is relatively expensive, and so is debt capital. So if they want to grow, they have to take more risk in an expensive capital environment. They also they do not like uncertainty, right? Because uncertainty in an economic environment means, well, I don't know if I should make this investment. I don't know if I should hire these people that I need to hire in order to grow my business. So low costs of having access to lower cost of capital is definitely one thing they need. A good, certain growing environment is another thing they need to help them make the capital and hiring decisions that they do. And plus they need many of them are consumer related, right? There's business to business related ones as well, but you need a consumer that's confident. I won't necessarily say it's the ideal time, but if you can find a high quality small cap that has good prospects, good management team, something where their business you can see out 5 to 10 years and go, yeah, this business is probably going to be bigger in the long run. That's kind of how I approach the small cap in investing landscape. Anything that you would disagree with? Anything I know you can add to it, so I'm not going to ask you to that.
No, I love that perspective. And I'll just quickly add that, well, yeah, I think traditionally you're right. You always view low interest rate environments, expansionary environments as typically beneficial for small microcap companies. And if I was going out and buying a small microcap ETF or something, that's probably the way that I would perceive it. I would just think when I'm thinking about individual stocks, that's how I like to perceive it individually. And there's something to be said about great small cap companies that stay afloat in tight environments, right? Who have great disciplined management teams, who have cheap stocks today because the environment's tight and they're cutting back, but they're making it work. Their backs are against the wall and their share prices are arguably cheaper today than they will be if and when interest rates come down. And I like finding those kind of like hidden gems. And as an individual stock investor, if I'm not investing in individual stocks, I'm usually just buying an index fund. I don't typically go out. I mean, sometimes there's an exception, but I don't typically go out and try to buy like a themed ETF or something. If I'm going out and I'm interested in buying small caps, I'm looking for like that great small cap, not small caps in general.
Yeah, that's such an important point that you made, and it comes from what I'm about to say comes mainly from the sports landscape, and that is you learn way more in failure than you do in success. And I won't say small caps are failing, but you learn more in difficult times than you do in the easy times. And so yes, I completely agree. These entrepreneurs and who love their company and want to see it be successful, learning to navigate the situations that get thrown at them is so important for the long-term success of a company.
I love that. Okay.
All right, we got a few minutes left.
Me?
What do you think? Where do you want to go?
I know I have one here, and I don't know if it's the best one to end on. Maybe we can hit on one more. I don't want to take it away from you, but I would love to address it. And there's a question here asking, is Mercado Libre still a 5X candidate?
We can definitely talk Mercado Libre.
Yeah, we did. We spent a fair bit of time in our investing team meeting on Tuesday talking about Mercado Libre. This is the Latin American e-commerce business, often referred to as the Amazon of Latin America or South America. For any investors who are unfamiliar, but Mercado Libre is an absolutely incredible business. And not to bury the lead here, but yes, I still very much think that it's a 5X candidate. Now, the timeline there, as we started off the show talking about, anybody's guess whether that's 1 year or 15 years. But the risk profile for Mercado Libre, I think the takeaway from our conversation has pretty dramatically changed today versus when it was recommended, I think, by a lot of fools. Calling it an e-commerce business is kind of like calling Amazon an e-commerce business. It might be the thing that you're most familiar with, but it is not what's driving the profits for the company. For many, many years, I think from like 2020 to 2022, 2023, Amazon's e-commerce business did not generate any profits in North America. It was all AWS. Amazon Web Services is generating the vast majority of profits for Amazon. You never know it by your familiarity with the company, but the same thing is kind of happening with Mercado Libre today. We don't have all the facts because of the way that Mercado Libre breaks out, or lack thereof, of their segments, But effectively, the speculation and the assumption that I think investors can safely make from what we're seeing quarter after quarter is that the vast majority of the profitability of Mercado Libre's business today is not coming from the e-commerce operations, but rather from the financing arm, Mercado Pago, and the expansion of credit lines in countries like Brazil and Argentina, especially to consumer credit cards and merchant financing. And that's a great business for underbanked consumers and merchants, but it's a risky one.
I completely agree. What I'll say is this is a business that has been around for a while, and it's been, because it's a digital business, it has so much data. And that, from my perspective, look, they're going to expand into different markets, right? They're going to take their platform and do all the things they want to do with it. And they're going to make the decisions based on the data they have, and the data that they are able to collect and analyze, and all this. They've proven to do that pretty well, but as Emily so rightly pointed out, doing it in if you're going from a e-commerce segment to basically banking, right, finance, it's a little bit of a different animal. So you have to be careful. The company definitely has to be careful, but I still think from a long-term perspective, this is just a fabulous business. Well, we've hit the top of the hour. Thank you so much, everyone, for spending this hour with us. Emily, it was awesome to do this with you. And as always, your insights and information you shared was amazing. And with that, we're going to kick the next hour over to our fabulous Foolish colleagues, Asit and Dan. Take it away.
Thanks, Fools.
Thanks, guys. Dan, how's it going?
Asit, it's been a while.
I know.
I'm doing great. How are you?
Great. So nice to be back with you. I feel like it's been since the pandemic that we actually spent some time together on live. So this is really great that we could do this hour together.
I'm glad to, Yasser, full members, just for a heads up, this was sort of a last minute substitution. Yasser El-Shimy had something come up, and so I was available. I'm doing the 3 to 4 hour as well with Jayson Hall, and Yasser asked me if I could fill in last minute, and I always love talking to my Fool members for 2 hours rather than 1 hour, and I'm really interested in learning more about and kind of sharing what I've come to know and love about technology stocks, semiconductor stocks, consumer discretionary stocks, and pretty much any other stocks that our members want to ask us questions about. I think we'd probably be game for just about anything.
Yeah, I'm not sure that there's an industry that you can stump Dan on. Maybe I should raise the ante here and say, all right, guys, send us a question that's going to stump Dan. But we won't make into that because he's got 2 hours to.
It's a mile long and 6 inches deep, Asit.
I'm the same way, my friend. Same way. Well, listen, let's start on this question that's, I think, very important. Probably everyone here wants this question answered first. It's from David Atkins. This is Go Heels, number 38 in the NET, which is a statistical ranking category. Do they make the field? Okay, maybe not everyone is itching to hear the answer to this, but I am a Tar Heel alumnus of the school and a rabid UNC Chapel Hill basketball fan. So I'm going to answer this question, but relate it to investing, Dan. I'm going to try. North Carolina really is a storied tradition in the college basketball world. It's one of the so-called blue bloods. They've had some transition at the top. 4 years ago, former player and also an NBA player, Hubert Davis, took over the helm, and the team has had some, successes and some sort of abject failures in those 4 years. We've tasted the thrill of getting all the way to the finals early on in those 4 years, and we've also missed the NCAA tournament. We're on the bubble this year, and for those of you who don't follow basketball, that simply means that during the seasons, as teams play, they sort of acquire some credentials to make the final tournament. You have to have a winning record and some quality wins. And so we're in danger of perhaps another year we don't make what's called the big dance, the NCAA basketball tournament. But, we've won 6 games in a row, if I'm not mistaken. It's 6 is the streak. And Dan, what happened was that Hubert Davis made a tweak to the starting lineup of the UNC basketball team. It was really a collection of faster and smaller guards for most of the season. And he sort of switched that up to some taller players, some forwards. And that has provided stability in the center. and allowed the team, I think, to have a more natural expression of its offensive talents, and they're playing really good defense. So this is to say, sometimes we buy businesses that have been successful for a long time, and they hit quarters where it just seems like management really doesn't have it together, and we wonder, will this company sort of ever recover or attain its past glory? And the answer is that, we often do see truly great companies get things right after some tinkering, some acknowledgement that, okay, what was working isn't working today, so we need to make some changes. And I always think about this in context of great companies like Netflix or the Trade Desk, which we just saw has had quite a trail down since its last earnings report. Or Amazon is another company I can think of. So many great companies which have had stumbles that have really shaken off the adherence to those businesses. And it's like, I don't want to call them fair weather fans, because that's not really a great analogy, Dan, but those investors who are sort of not studying the business as they go along, and they become big holdings in their portfolios. So we get very skittish when that happens, and sometimes bail when we shouldn't. But I know it's hard. It's more difficult than it sounds. And if a company has become a significant part of your portfolio, let's say it's 7, 8, 9, or 10%, sometimes you have to slow down and do the work of going back and really understanding where it is today, what the future looks like. Sorry for that long-winded answer. I saw that question, my eyes started glittering. But I'll turn it over to you for some thoughts on that, Dan, or if you want to start on maybe the real investment questions, that's great.
No, Asit, this is good. And I love the analogy because it is very good one. My Houston Cougars are in the top, probably might be getting the top seed if they don't blow it in the tournament. I remember way back when, trying to come up with investing analogies. It's one of those, when I was a kid, I grew up in Houston, and this was the era of the Phi Slamma Jamma with Hakeem Olajuwon and Clyde Drexler and a whole bunch of folks who ended up going to the NBA, had reasonably good careers. And, but they never won that championship at the NCAA level. They lost a buzzer beater to North Carolina State, Tar Heel, probably not the arch rival, because I'm guessing Duke is probably the arch rival, but, in-state
the rival
rivalry.
we hate the most. Believe it or not, I think there's even more hate for State than Duke. And I remember that Lorenzo Charles grabbed the ball in transit and dunked it, and quite a fantastic finish. But what a storied team that Phi Slamma Jamma team was. Amazing. It's so beautiful.
And it's a heartbreaker, and it's a good reminder. Sometimes good stocks will seem like they break your heart, but hopefully it doesn't take. Gosh, it's probably 40 years. Probably doesn't take. You hope it doesn't take 40 years for them to come back, but you definitely have seen some stocks that they seem to just kind of plod along for years and years and don't do what you expect. And then suddenly all of us, coming out of nowhere and kind of jumping up. I think of NVIDIA, ticker NVDA, for that, because, there was plenty of time there where, that stock, people thought of it just as a gaming chip stock, that, graphics processing units were, kind of a cool thing, but not necessarily like, but for all purpose work. It was just for fun. And so, back then you're looking at, rivals like Intel, ticker INTC, as, being able to build on their PC dominance and continue to evolve with technology. And what happens instead? Suddenly, graphics processing units, people discover the hidden talent that those chips have, the hidden abilities that they have in driving this new technology. Then suddenly NVIDIA comes back through the roof. So interesting things there. I wanted to grab a question from that came in before we started, Asit, but
Sure.
It is consumer discretionary. Jennifer Wengert asked 46 minutes ago, is Wingstop, ticker WING, affected by the culling of chickens due to avian flu? So, Jennifer, I think that what I have seen is that as chickens, the question is whether chickens are going to be able to, once they're culled, is the question becomes, are they being culled because they have been infected themselves with the flu? Or are they being culled as a preventative measure to avoid overcrowding, as kind of a quarantine restrictive measure. To the extent that those chickens that are being culled, to the extent that you can use those wings, then that could actually have a temporary downward push on prices and therefore on costs for Wingstop. And so Wingstop would potentially not have a margin hit. And so it's kind of different from egg production, because with egg production, once the chicken is gone, you've lost future production of the eggs. And so as a result of that, like that's more of a thing. When it comes to wings, though, it's more a question of throughput of overall chicken processing. That, you know, you have egg laying chickens and then you have meat producing chickens, and where that ends up, you know, I think that it's going to take time for that to play out and to kind of see cross-pollinating where avian flu becomes more of a problem, where it's less of a problem, whether the industry is able to confine its influence in ways that avoid that kind of you know, coming over. But I think I read, can't remember, it was probably a few weeks ago, some comments about this, and that, you know, Wingstop had not seen a big change in chicken wing prices, and that you know, certainly not to the same extent that you've seen consumer egg prices kind of go through the roof lately.
Yeah, it's interesting, Dan. So the CEO of Wingstop a couple of years ago came on board, Mike Skipworth, and he made an interesting decision in some ways to invest in the supply chain, but not directly. So you haven't seen Wingstop really try to control its supply chain. They've taken the money they might have invested directly in that and put it in other places, in unit expansion, taken some cash flow and upped the marketing spend. And those moves are really paying off for Wingstop as a business. Now, the stock has retreated some from its highs over the last quarter or two. But I think that probably was not a bad decision to make, because ultimately then you become sort of a quasi-producer yourself, and that's an even harder business. So investing in technology with preferred partners probably is the way to go. Just thinking about supply chains in general in this industry, and how volatile they've been over the past years since the pandemic. So I thought that was good, but time may prove me wrong. Maybe the idea is, as you grow bigger, is to seize more control of that so that you're less subject to the vagaries of chicken supply chains. But we'll see. We'll keep an eye on that. Great question, though.
Do you have one you want to take, Asit, or do you want me to keep going?
Yeah, I'll grab one right at the top here from Dimitris. Any thoughts about AMD? Do you find the current price attractive? You know, Dimitris, I found in just chatting with some colleagues, even the folks who are skeptical about AMD are saying the price looks cheap to them. It does to me. I am a little bit of a AMD advocate or bull. I acknowledge a lot of pressure that the company has to obtain market share in the GPU space against such a formidable competitor like NVIDIA, but it's a very diversified business. I mean, they compete in a lot of spaces. They've taken market share from Intel in the server space. They also produce lots of bespoke type chips that are used in industry from an acquisition they made a few years ago. So things like FPGAs, field programmable gate arrays, chips like that. And I think the next series of accelerator that they have coming out this year, which will really be more of an impact in the second half of the year, their next generation accelerators is pretty good. Is it going to like invert the equation? No. NVIDIA is going to remain dominant for a while, but can it help them get to this future in which their free cash flow from last year could double or triple within the next 4 years? Yeah, I think they're still on that path. And so as market headwinds hit the whole semi industry, that one in particular sticks out to me as one that is potentially undervalued. It's definitely at a fair price, and maybe cheap is in the eye of the beholder. But my thoughts are still fairly positive on that business.
Down 50% in the past year, so for sure there's been a remarketing or a remarking to market of expectations for ticker AMD. But you know, they're used to being number two.
Right.
It's unfortunate, you know. I mean, they were in that graphics processing unit area as well, and so, you know, it just seemed like, you know, NVIDIA was, I'm a cyclist sometimes, and you get in a row where one person's in front pulling and everybody else is drafting and
Right.
kind of following right behind.
Close to
It's
the wheel.
almost like Intel was in front, and then NVIDIA decided, you know what, we're going to pass up AMD as number 2, and then we're just going to pass up Intel and just go to the front of the line. And AMD took over Intel's spot, but is still kind of drafting. So I'd be interested to see where
I think that's not. I think it's not a bad analogy at all. But it's so weird because AMD is actually one of the most innovative companies on the planet, and what it had to do to completely change its business and get out of the manufacturing end and become a designer and overtake Intel was pretty amazing. They did that in a short span of years under Lisa Su. It's just, the prowess of NVIDIA even overshadows that. Don't disbelieve this. AMD itself, I mean, is crazily innovative and run by another superstar CEO. And I have to read this comment at the top here. Janie McFool says, "Go Heels! Thursday, 11 a.m. Our number 5 Lady Tar Heels play number 12 BC or 13 Syracuse, playing now at the ACC tournament in Greensboro." Janie is in Chapel Hill, home of the UNC Tar Heels. All right, I'll tone it down now, folks. I know you don't want me to bring all this partisan banter in this bitterly divided sports landscape. We try not to be political here.
When you have two teams both looking to be tournament bound, that's something to celebrate. That's something to celebrate.
Yeah, fun time. Thanks, Janie, for that comment. Justin
A asked 39 minutes ago, do you expect the NASDAQ 100 and I think that's the Ultra Pro QQQ 2X or 3X, I can't remember if it's 2X or 3X ETF, to rise or fall more? And Justin, I brought this question up in part to talk, mostly to talk about leveraged ETFs, because over long periods of time, I do expect the NASDAQ 100 to keep rising, perhaps not at the pace that it has done in the past 10 to 15 years, really a blistering pace for the technology heavy index. For sure, the NASDAQ 100, there's nothing that is necessarily technology based about it. All it is the 100 most valuable non-financial companies that are listed on the NASDAQ. But it just so happens that most of those big tech names are listed on the NASDAQ, and most of those big tech names are the biggest companies in the index. It is the NASDAQ 100 is a market capitalization weighted index. And so you're going to have technology disproportionately represented. One thing that I am troubled by, though, is when people try to get too much of a good thing. And leveraged ETFs like ticker TQQQ are one way that people can get themselves into trouble. Now, to be sure, that leveraged ETF has done extremely well over certain periods of time. For those of you who aren't familiar with these Ultra Pro, these leveraged ETFs, they are designed, they use derivative strategies to try to, on a daily basis, give you a multiple of the return of whatever index that they are underlying. And so you may have a leveraged ETF whose goal is, if the NASDAQ 100 goes up 1% in a day, the ETF will try to go up in that day 2% or 3%. You can get different levels of leverage depending on how much leverage, how much risk you're willing to take on. The problem with these ETFs is in the key word that I just said was daily return, because the derivative strategies that these ETFs have to use in order to generate those daily returns, they are based on those short-term moves. And what can happen with this is that over time, like over the course of a month or 6 months or a year, a lot of people make the mistake of saying, well, if this ETF is doubling the daily return of the NASDAQ 100, then if the NASDAQ 100 rises 10% in a year, well, then my leveraged ETF should go up double that, 20%. But the way that the volatility can work often makes this not work out. And in fact, there are some leveraged ETF pairs where oftentimes with a popular index, you can find two different ETFs that follow either end of the strategy. You can bet that the index is going to go up. You can bet that the index is going to go down. And I've actually seen the way that the math works with ups and downs. If there's a lot of volatility, if the index doesn't go in just one straight up or straight down move, then you can have situations where both the bullish and the bearish leveraged ETF lose value, even if the overall index went up. And that all comes down to those daily moves. And so, I highly suggest that people be very careful about using these leveraged ETFs as long-term holdings, because they're not designed to be long-term holdings. Many of them in their name say daily, to emphasize that fact that it is a short-term, it's intended to be a short-term vehicle. And so not something that a long-term investor generally should be using. Sure, the TQQQ did produce really amazing results during periods of time when the NASDAQ 100 has been would go straight up. Sometimes you'd get even more than the 2x or the 3x that you would have expected looking at the prospectus, just because of kind of the compounding amplification that you get. But it can be dangerous, and it can end up moving in directions you don't anticipate, just based on that short-term nature and the way the volatility works.
Just a quick comment on that. And I love that explanation, Dan. I had some personal experience with this type of investing. It's really trading in my 20s. The lesson that I learned is that it's very difficult to time things and use leveraged instruments. Almost all leveraged instruments operate on a time factor, whether it's a futures contract, an options trade, or this dynamic that Dan just described with a leveraged ETF or ETN. And so you have to be directionally right, and you have to know when to put your money in and put your money out. And I found that the ease of buying something that has fundamental value that's going to grow and almost forgetting about it, for me, is a very strong principle versus having to have an edge over the house, I'll call it, to be right a certain amount of the time. And when we look at leveraged instruments, actually, if we do that with any frequency, we're trying to assert that we've got some kind of edge over the market. We're right more than we're wrong, and that we can also manage our capital in a way that doesn't hurt us in the times we lose. So those are two skills that are underrated in that kind of investing. Just be aware that they're required. And if anyone wants to go that route, I wouldn't dissuade someone from scratching the itch. I just advise them, don't make it the biggest part of your investing. And so here's a good question.
Actually, Asit, let me just throw in one other thing before
Absolutely.
we move on from that, just because I
Sure
did have a chance to kind of take a look at the returns. And, over the past year, NASDAQ 100, pretty good year, looking back 12 months from today. So it does include the recent downturn that we've had, but still the NASDAQ 100 is measured by the Invesco QQQ, which is ticker QQQ, up 15%. That TQQQ ProShares Ultra Pro NASDAQ 100, it is designed to be a 3x leverage. It's up 22% versus 15% for the underlying index, not 45% like you would expect. And that's just because, again, the amplification of the ups and downs ends up mathematically hitting you. So just wanted to put that in real terms for investors who may have been holding that for the long haul and wondered, hey, that's not triple what I got. That's kind of where we've been going with that.
And it seems an inordinate amount of risk for 7 percentage points of additional return as well.
Yeah.
Because obviously on the downside, when you're holding those instruments, it's psychologically pretty hard not to try to get out if something is going down on a daily basis or trying to replicate 3x movement. It gets hit on the downside. Okay, so going back to our queue, the question was, and I've lost it, but I have it here in our chat. Trish McDowell said, what to look at in an IPO, and gives a ticker for a company I don't know, OMS Energy. But I like the question. IPOs through the Securities Act, I think it was like 1933 Securities Act. I may be way off here, but one of those 20th century acts of the SEC, they actually are required to disclose more information that we would typically even get in an annual report. So I sort of love it when a company I'm interested in goes public. Doesn't mean that I'm going to buy shares in that company right off the bat, but I love the opportunity to study it. And so what do we look for when a company comes to market? I'll tell you what I'm most interested in. First is the story. The prospectus usually tries to give you an overview of the business in maybe the format of a letter to shareholders or a very nice slide presentation, but you get a condensed view of the business, the model, and you'll often get some schedules of relevant statistics. If it's a company that's a platform business, they might talk about customer acquisition cost or long-term value of customers, how you should gauge that business. The other thing that you get is, sort of the pro forma look at the financials. So you get to see what this heretofore private company has churned out in terms of profit and loss, what its resources look like, how strong the balance sheet is, what cash flow is. And sometimes you get a projection of how the company might get through that first year, again, on a pro forma basis, if there's like a business combination involved. And sometimes these IPOs contain a business combination. Now, the crucial section for me usually comes down to something called use of proceeds. That's a required section in this S1 document. So the S1 is the document which encompasses the company's prospectus, its financial statements, its all its risks, etc. So look for the S1 on sec.gov, the Edgar site, for the company you want to study. And they'll tell you right there where the money's going. Sometimes I'm interested in a business model and I find that all the money that they're going to raise is going to go to pay off some debt, and the company still appears leveraged. So basically the public is going to ease their debt burden and none of that money is going to go for anything of use. Other times you'll see that a company is going to put money towards working capital needs and maybe invest in planned acquisitions. Or in this case, I did glance at the company that you mentioned. It's going to use 12% of the proceeds for research and development. Now, I have no idea what they really do, but this is the kind of thing that's so interesting to look at. So the use of proceeds section is very important. And of course, just as you would for any company that you find in the wild or that's been trading for some time in the public markets, evaluate the risks. Usually these S1s have a pretty substantial risk section, so you can understand what is going on if you buy shares, what could be the pitfalls of that business. And basically, there's a lot of information that then gets replicated in forward years in 10K annual reports. You can also find those on the SEC sites. But I think it's just a great opportunity, not just to learn about a business, but to improve your own investing skill. Spend some time with an S1. They are very daunting documents. Some of them are hundreds of pages long, but the crucial sections themselves, you can just use the table of contents. Usually you've got nice little hyperlinks there and go to those critical sections. And in this day and age, take stuff you don't understand, feed it into an LLM and try to have the LLM explain to you exactly what the company's saying. That can be very helpful.
Yeah, at the very least, getting a summary of a 200-page document like that using an AI tool can it's definitely better than not reading it, which is what a lot of people end up doing, and they just kind of say, oh, well, this IPO is being hyped and they've got a good business, and they look at the investor relations presentation, kind of the dog and pony show that they come up with, and don't dig into the S1. I remember, oh boy, it was not fond at the time, and nostalgia does this a lot. But one of the jobs that you may have as a summer associate in law school or as a first year associate at a big law firm is digging through those 200-page S1s and making sure that everything was disclosed and that every risk factor that you can think of is in there. Understanding that hardly anybody's going to read your work, but nevertheless, and I still do surprise some folks. I'm one of those people who read the rental car contract before I sign it. Just kind of take it, taking a look.
I always figure they're going to get me either way.
Well, that's a good
so
point.
I just sign.
Usually, it's just an excuse for conversation to get people to laugh at me because it ends up being fun.
To be completely honest, I scan mine. I do take a quick read, but go ahead.
I did want to mention, we here on Fool24, we are not permitted. There was a question that came in about ETFs that a sister affiliate of the Motley Fool manage, and we're not able from a regulatory standpoint to discuss those. So that is why that question went away. The question I wanted to grab real quick. Let me get this follow up from JBL. It's talking about, again, that ProShares Ultra Pro NASDAQ 100, the ticker TQQQ. Does this mean it is better to buy in a bear market but needs to be seen as a short-term holding? No, I may have confused you, JBL. TQQQ is the bullish version of that ETF. It gives positive triple exposure to the NASDAQ 100. So on a daily basis, if the NASDAQ 100 goes up 1%, the idea would be for the TQQQ to go up 3%. And so that would be a better holding in a bull market. There is a similar holding. It is ticker SQQQ. It is, what do they call those things? It's like the Ultra Pro Short QQQ. It gives you minus 3 times the return. So it's what's called sometimes an inverse leverage ETF, where if the NASDAQ goes up 1% in a day, this ETF is designed, it would try to produce returns that fell 3%. The idea being that if you wanted to bet on a short-term bearish move, then for every 1 percentage point in a day that the NASDAQ went down, this ETF would go up 3% if the strategy worked out. And again, these ETFs usually do a pretty good job of tracking their daily goal. It's not perfect. They don't always get it right, but often they get it close. It's when you start to get these longer term impacts that suddenly you're in a position that it doesn't quite do that. And then Ed, 32 minutes ago, what percentage of an average portfolio with higher risk stocks such as Lemonade, ticker LMND, Upstart Holdings, ticker UPST, Rocket Lab, ticker RKLB, ticker ASTS is AST Space Mobile, Transmedics, TMDX, Elf Beauty, ELF, etc. Should you have and be comfortable with it? Ed suggests maybe 15 to 20%. Ed, you know what? I'll tell you, I've seen this, variations of this question get asked all the time. And the real answer is that each one of us has a different risk tolerance. Each one of us has a different comfort level, and each one of us has different goals that we're trying to achieve. And if you are in a position where you can achieve your goals by taking less risk, then you might have a relatively small portion of your portfolio invested in individual higher risk stocks. You might avoid higher risk stocks entirely. But on the other hand, if you're just getting started out, you have a particularly high risk tolerance, you're in a position that you can afford to take kind of outsized risks in the hope of increasing your chances of finding that 10x, 20x, 50x multi-bagger, then having a percentage that is higher, it may work out for you. It's not necessarily something, one thing that we here at the Motley Fool, the philosophy that we have is 25 or more stocks, individual stocks in a portfolio. That's to mitigate the fact, even when they're high risk stocks, as long as the risk factors aren't aligned, then your hope is that if there's something that causes catastrophic damage to one particular company that you're investing in, that you still have good chances with the other 24 that at least some of those are going to produce those exceptional returns that you're trying to get. Because it only takes 1 or 2 out of a 25 stock portfolio to really make the difference between beating the market and matching the market or trailing the market. And so that's something that often comes up, and it ends up being more of a personal decision than anything else. I'll say, how do you take Ed's question when you're, because you deal with stocks kind of across the spectrum. You deal with some stocks that are more cautious in nature. You deal with some that have more moderate risk, and then you have some that really do take aggressive risk in their business models. How do you view it? Is it something in your investing that you have a comfort level with, or how do you handle it for yourself? You may be muted, Asit. I'm not sure.
I'm sorry about that. I like what you said about this being personal. We all have to start with our own investment goals and our time horizons in investing. So, you work backwards from there. For myself, I like to think in terms of position size in my portfolio. I try to control that, have entry points that are 1% or less of my portfolio. And some companies that succeed will grow in value and they'll become a bigger part of one's portfolio. But I don't like to stuff that number up front. In other words, to anchor on a couple of stocks and say, I'm going to just purposefully build these up to multi-percentage points of my portfolio. Over time, I have no problem as I study a business in adding to it as I go along. And I don't think the strategy, and we're talking theoretically here because we can't give personalized advice, of drawing a circle around high risk stocks. I don't think that's bad at all. If you understand your own risk tolerance, what that can mean, if you scenario out how markets might perform, the effect on your total portfolio of say having 15% of pretty aggressive names. Again, I would advise those be split among numerous positions to anyone who's trying to develop a portfolio. So in that sense, it can really work out. If you are maybe someone who's more interested in capital preservation, though, that may be the reverse of what you're actually trying to achieve because you're looking for other things, stability, cash flows, dividends, etc. So yeah, I really, my approach is very much what you said, Dan. It depends on you, what you're trying to achieve. The only overlay I put for myself is to understand the risk at every level, how much of that risk is correlated. And you spoke to this as well. Sometimes there are correlations that we don't see. So we really need to be aware as we look through our portfolio. Even though two businesses look like they're in way different industries, they could both, for other reasons, be correlated in price movement because they both happen to be stocks trading at a beta of 2.0. I don't know, some high beta.
Yeah.
So yeah, that takes a little bit of thinking through and experience. But the good news is, we're always in learning mode. Dan's been investing for so many years. I know him to be like a continuous type of learning adherent, and I am too. So we learn as we go along. I have a question here from Matt, which is, Asit, do you consider Williams-Sonoma, this is ticker symbol WSM, to be a consumer discretionary brand business? I did see that Motley Fool scoreboard episode the other night with Dan and Toby, and I haven't had a chance to see that yet, Matt, but it's an intriguing question because without putting any thought to it, many of us would probably say, myself included, I guess, yeah, Williams-Sonoma is a consumer discretionary company. But there are reasons that I can give that would maybe push this to having some flavor of a consumer staple business as well. How could that be? Like, don't they specialize in like home furnishings and furniture? Don't they have some like higher end brands? I think West Elm might be one of the brands,
Yep.
Pottery Barn.
Yeah, definitely.
Yeah. And for me, it comes down to what's gone on with housing over the last few years. The housing market is so tight. Interest rates are very high. There seems to be a continual demand in the marketplace, at least for the foreseeable future, for those who may be constrained in their market. So you'd like to sell your house. It's appreciated. You have equity, but any kind of house you'd want to move up to is even more expensive, or you're not really getting anything in return because things are so elevated. And if you're borrowing, you may decide to stay in an apartment. So the natural evolution for companies like Home Depot and Lowe's has been to try to support those smaller project business streams that they have. And there's a correlation there in a business like Williams-Sonoma. If you're trapped in your house, you do have some discretionary income, but for you, it's almost like a consumer staple. You're going to spend that money to upgrade. So I've been surprised by its solidity. I own Williams-Sonoma, and I have put it into one of the portfolios, the only portfolio that I manage by myself. And believe it or not, it's a tech-heavy portfolio. It's like the third or fourth best performer over the last couple of years. I think I'll have to check the chart, but I think the stock has almost tripled over the last 4 to 5 years. Any thoughts on Dan? I know you have more questions to tackle than I do too, but be curious if you've got.
It's an interesting, the sector division between consumer discretionary and consumer staples is an interesting one because, I understand what makes a staple, or at least what S&P calls a consumer staple stock. It's something that you need on a regular basis, and you really can't put it off. So, stuff like groceries are going to be a consumer staple because, you need it. It gets a little murkier. I think last I checked that tobacco companies were consumer staple stocks, and that becomes a question of, well, once you decide to have that product, then that is something that you're going to use. Same way with beverages. Anybody who is watching on the screen might have caught me taking a sip of Coke there just a minute ago. Coca-Cola considered to be a consumer staple stock, even though there's no physical need for anybody to have a carbonated soft drink with a whole bunch of sugar in it. But there you go. On the other hand, you have these consumer discretionary stocks where, it's the sort of thing that discretionary implies that, well, you could buy it or you could choose not to buy it. But there's discretionary and then there's discretionary. You don't need to buy a mattress very often, but most people prefer to sleep on a bed. And so there is a time where making that big purchase of a bed is essentially going to be a staple. The attempt, I think, that they're trying to make by drawing that distinction between those two subclasses of consumer purchases is just to, if you were in a pinch and you had a mattress and it was old and it wasn't very comfortable, but the economy was bad and you weren't in a position where you could put together, several $100s to buy yourself a new mattress, then yeah, you could put up with bad night's sleep for a month or 2 months or 6 months or however much that you needed to do. Whereas you're not going to be able to put off, buying food. That's just not something that you can do. But I kind of feel like there are true luxury items that are really discretionary in nature, where you could buy them, but you could also live your life quite happily without them. And then there are these things that they fall into that same discretionary area, but for a lot of people, they're not nearly as optional as some of those luxury items. Things like automobiles, classic consumer discretionary. But a lot of people live in areas where alternatives to owning a private vehicle just aren't very good. And so to that extent, you do have some locked in demand. I'll just point out, that the scorecard or scoreboard that I did with Toby was a ton of fun. Recommend it, go look up WSM on Fool IQ and find in the coverage area, you can find that video that Toby and I did. Toby knows a lot about it. And so
Right.
it was definitely worth a read for anybody who's interested in that space.
And Dan, did I intuit the issue correctly? Was there some discussion on whether it was actually discretionary or if it sort of straddled the line between staple and discretionary?
I don't think Toby and I just addressed that upfront in that video. It's short video format, by the way. So,
right.
You kind of have to compress the argument, but a lot of it just turns on when you have a consumer brand where customers have a ton of loyalty, and Williams-Sonoma definitely one of those. Then what seems like it ought to be a discretionary stock often ends up looking more like a staple stock because you get these repeat customers and they're kind of locked in. Plus, when you have kind of an upper scale demographic with more discretionary income, with more purchasing power, they're less cyclically hit. You aren't necessarily going to see, you will see in some cases ups and downs in demand, but there is a level of kind of pent up spending power that people have, that those loyal customers have. They'll keep going until, they'll keep going longer than you might expect until, if they're having a financial problem, until that financial problem becomes kind of deeper than they can handle. So let me move on.
Yeah,
There
go ahead.
was a question. I was going to grab Vihan's question. Dan, can you sell a stock ticker A, like whatever ticker it is, in a taxable account at one brokerage and claim a tax loss, and then buy that same stock back in a Roth account at a different broker on the same day and the next day? And Vihan, the issue here that you're bringing up is something that's called the wash sale rule. So you can always sell a stock in one place and buy it back in another place. That is allowed technically. Nobody's going to stop you from doing it. But where the problem comes in is if you have a loss, if you have lost money on your position in that taxable account, then when you sell that position, you are able in that taxable account to claim that capital loss on your tax return in the year where you sell the stock. And you can use that loss to offset gains on other stocks, on winning stocks, if you sell those shares during that same year. In addition, there are circumstances where you can use that capital loss against other types of income or carry it forward to claim against gains that you might incur in future years. Just kind of depends on your individual tax situation. However, there's a rule that's called the wash sale rule that says that if you buy that stock back before a 30-day period has elapsed after the sale, then you will not be able to claim the loss. The loss will instead kind of get baked back into the tax basis of the replacement shares that you bought shortly after the initial sale. Now, in a taxable account, that's less than ideal because you were hoping to claim that loss. But if you buy back in the taxable account, at least there is a tax basis to be adjusted upward so that in the future you will essentially get credit for that loss. Kind of the worst mistake that you can make is buying that stock back in a tax-favored retirement account, whether it's a traditional IRA or a Roth IRA. The problem there is you will lose the tax loss. And because it is in a retirement account, the tax basis that gets adjusted upward as a result of the wash sale rule doesn't really have any impact, because in a Roth account, any gains are going to be tax-free. And so you're not going to get any benefit from having a higher tax basis. Even a traditional IRA, money that comes out is going to be taxed at ordinary income tax rates, regardless of whether it's a capital gain or a capital loss. And so that is something definitely to avoid, buying it back in the same day or the next day. Wait that longer than 30-day period so that the wash sale rule does not apply. That's going to be probably what your accountant's going to tell you to do, Vihan. And yeah, it does not make a difference if it's at a different broker. It does not make a difference if it's in the same account or a different account. The IRS has ways of knowing these transactions get reported to the IRS. And so they can find it and they can make the adjustments accordingly.
So I want to respond to Bibo's request here, and then I'll take a question. Bibo says, please use inexpensive instead of cheap, as cheap means that it inherently is not worth what you pay for it. So Bibo, I'm going to respectfully disagree there. The idea of cheap, denoting a lack of quality, is like a tertiary definition. If you look it up in the dictionary, so the definition of cheap is inexpensive. That's per most dictionaries. And I'm not saying this off the top of my head, because I've had this argument with other investors for years. Like, why do you say cheap, Asit? Come on. You're trying to demean this company. Actually, I'm not personally. It's common parlance in investing among investors to call a stock that may be on sale, to call that cheap. And I understand where you're coming from, because yeah, in the English language, sometimes we can denote something less than great if we say cheap, but like Shop Talk says that cheap is okay. You can use cheap and mean inexpensive. It doesn't mean that you're degrading the company. at all. But I appreciate your question because I'm an English major and I'm a lover of words at heart. So I couldn't pass it by, not because I wanted to disagree with you, just because it's a great question.
Precision is important for
Yeah,
sure.
what's
And,
cheap
you
mean
know,
versus inexpensive?
remembering that some people may take your words differently than how you intend them to be taken it's always a good it's a good humbling lesson for all of us.
Yeah, absolutely. And there's Dan's very polite rejoinder to me that you could actually choose your words more carefully and you wouldn't even have to answer this question. Okay, so let's move on to the question that I wanted to hit, which is this is from Ed. This is about an hour ago, and I'd like Dan's thoughts on this as well, if you can. So the trade desk at $65. Wall Street still does not like it at these prices. A good stock usually would have rebounded somewhat. Wall Street must see something that their issues aren't short term. And so I can present a case where maybe it doesn't mean that, Ed, and that's simply sometimes a company gets re-rated in the marketplace, which means people buy management story and understand, okay, there's some near-term issues, but then they question, is it really worth whatever the former multiple was? And the answer may be no, it's not. And here's what it's worth today, given that there's not this clear path to the sort of revenue growth we expected or cash flow growth. It doesn't mean if the company rebounds in its business next quarter that we won't adjust that multiple up again. But let me get to the heart of what you said. I mean, I've actually come full circle on this. I used to pretty much discount if the street took a business down to 65 like the trade desk and it stayed there because I was so much into the business fundamentals, and I still am. I'm a business first investor. Look at the business, not the stock price. But I read a blog post from Aswath Dhamarajan a few years ago. He's the famous valuation expert at NYU, and he made a case for paying attention to that sort of collective wisdom of sell-side analysts and retail investors and institutional investors, basically saying that's a signal for you to do some more homework. It's not that you should just dismiss those short-term reactions out of hand. If a stock really takes a beating after a quarter, it almost behooves you to more double down on understanding why trade desk is still sitting at 65. So there's some real value in looking at it like that, Ed, which is to say, okay, I mean, if this were just simply a case of execution, why wouldn't it have gone up? There are other things that the market is worrying about. So yeah, I think to me that this is a signal type question. What are your thoughts here, Dan, on this approach to looking at stock prices after a company maybe whiffs on earnings or has some kind of business change?
So I did before I get to my thoughts on that. I posted on the Slido channel a link to the video, the Fool24 session that I was lucky enough to do with Fool CEO co-founder Tom Gardner and Chief Investment Officer Andy Cross. That was on February 13th, which was the day. It was the night after the trade desk released its most recent earnings report. There was a big drop on the day as the company went through some of the execution issues that it had with respect to its the rollout of its Kokai AI product, as well as some other things that they missed expectations. They missed their guidance for like the first time in several years. I can't remember the number of consecutive quarters it was, but it was a high number of quarters, a long time. And that always causes people to kind of take a look. But the one thing that I'll share two things. One is that when I was thinking about this, and pretty much the guidance that I give anyone when they've seen a stock take an unexpected turn, whether it's a huge move up or a huge move down, but more often a huge move down, because that's the sort of thing that gets us riled up. My suggestion is always take a break, give yourself a sort of a self-imposed time that you're not going to take action, because more often than not, it's a very disciplined investor who's able to take immediate action after a big move without it being emotionally driven. And especially if you are worried after a big drop, selling it immediately often leads to a problem if the stock bounces back immediately thereafter. It may be something that, it turns out to be short-term in nature, and you'll look back and you realize that you kind of got stuck with it. So that's point one. But I'll also say this. There are times when, just about every successful company faces some moment where something doesn't go quite right, and a beautiful track record ends up, getting just a little bit of a scrape in the paint or a crack in the windshield. And suddenly we realize that even the best CEOs, even the best management teams, even the best run companies aren't invulnerable from potential problems. The fact is that just about every long-term performer that you can find among Motley Fool recommendations, among other successful stocks, other high-yielding, high-return stocks over the years, just about all of them have major pullbacks. It's easy just to look at the stock chart and say, oh, yeah, well, there's a pullback, but yeah, it's going to go back up. But what tends to get forgotten is that for every one of those downturns in that stock chart, there was a reason why the stock went down. And it sounded like a compelling reason at the time. Like there was a good reason to look at this and to say, well, gee, they had a perfect track record. Now they don't have a perfect track record. Am I going to miss guidance again? Am I going to miss my expectations again? Or, has the whole thesis changed? Has the whole idea behind what you were investing in changed? And sometimes the answer is yes. And sometimes the right answer is to sell after a downward move. If the reason for the downward move is something that you think is going to last and is going to continue to be a problem. But if you wait a week, and I threw out a week in that video, but the time that you choose could be different. It's just kind of based on your temperament. But give yourself that break. Give yourself a chance to cool down. Give yourself a chance to evaluate the situation rationally without a whole bunch of emotion. And come to a decision. Has the reason I invested in this company changed? Do I no longer have conviction in what the company is doing? If the answer is I don't have that conviction, then oftentimes you may be more comfortable selling and reinvesting that money into a stock idea you have more conviction in. But if you are convinced that the downward movement is just something that's kind of inherent to the nature of stock market volatility, if you think the business model is still valid and will continue to produce long-term success, then that's a situation where perhaps you hold on to your position. Perhaps you buy more shares at what you see is kind of a perceived discount at that point. So, but the key is taking that time. For most investors, there's some remarkable investors who are able just to say, you know what, I'm going to respond directly to this, and they're cold and calculated and ruthless in some ways, because it takes that level of discipline to make those spot judgments. I'm in awe of those people. For me, I need the cool down time before I make a decision that I might well end up thinking is a big mistake.
Dan, there's some art to it as well. Listening to you, I was reflecting on having to learn over time that sometimes the answer isn't going to be revealed to you. Even the pause is so great. And I've heard Tim Byers on our mindset sessions, maybe a plug for that if you're newer to Fool24 every Monday at 11 a.m. now for an hour. We talk about mindset issues, but that pause, sometimes after a week, your answer to yourself is, yeah, I need more data. And that's not going to come for, another quarter.
Yeah.
At the beginning, it was hard for me in my investing career to wait. And I, more times than not, made an erroneous decision to sell a business. And I love to just highlighting that if something is truly changing that affects your thesis, it may not be crystal clear, but it's sort of obvious. You sort of understand, okay, this is not what I bought into. And those decisions may not be as hard as they look as we're theoretically discussing them now. But the patience part of it, is something that took me a long time to get right. And now I am a little slower to sell, and I'll take the risk that things could go a little further south within the next 90 days till I get the next report. Unless, of course, I really feel, boy, this is sort of was a brittle thesis and I didn't understand it, and now it's snapping. So I'll take that decision. But always after a pause, after an interval is the way to make that decision. So we've got less than a minute left. I know you're staying on for the next hour. I see my buddy Jayson Hall is up. Is there anything else we could tackle in
Let me just close this out 30 seconds. Justin A, 26 minutes ago, follow up to that NASDAQ 100 TQQQ discussion that we had, said, the reason I asked, I was lazy until this week. I repent and quit this practice as of now, but I got stuck in on the second day of the dip, and now I'm hoping the recovery versus the loss. And that ties in well to what you were just saying, Asit, because too often it is easy after a big stock move to kind of change your thesis and to say, well, yeah, I always said that if this happened, that I wouldn't be interested in investing in this stock anymore. But now that it's happened, now I'm kind of having second thoughts, and it's kind of like, well, maybe it'll come back. And that pause can sometimes give you a little bit of time to reflect and to figure out, okay, is that heat of the moment? Am I letting my emotions get the better of me? That can be something. And that's one reason also that I am not a big fan of these leveraged ETFs, because like you were saying, Asit, there's a time horizon built into just about every investment. And the time horizon on these leverage ETFs is very short. And so you don't have the luxury of giving yourself as much downtime as you might otherwise want. You just don't, the risks are too great. And when you compress that time frame, I think you open up the risk of more errors in your judgment, in your investment decisions.
Agree. Well said. And now I must leave this stage.
No, stay. You can stay, Asit. You got stuff to do, Asit. Go on, buddy.
No, actually, I will. I'm just kidding. I know you guys are ready to go, and it'll be more value for the viewers. So I will head out for the day, but it was a blast, Dan, catching up again and
ton of fun
with you. Yeah, and Jayson, we got to get together soon in this format as well.
Agree 100%. We'll make it happen.
We will. See you guys.
Thanks, Asit.
Hey, Dan.
Hey, Jayson. Welcome.
It's good to be here. It's good to be back, I should say. It's the valuation hour.
Ton of fun. I just, it's one of these days where it's just kind of like, Andy, disappointment. I hope nobody's too disappointed. I don't know how early the schedule comes out. This was originally going to be Andy Cross instead of me with Jayson Hall, but Andy had something come up the last minute, asked for somebody to step in. I am just fresh back from a week in Vegas and the Desert Southwest. And so I was in one of those rare situations. You coming back your first day of work, and you got a big pile in the inbox, but you're kind of like finding ways to work yourself back into that. I got to work again kind of mode.
Well, Dan, it's funny because
talking to you guys is a great way.
It will catch you up, but it's a little bit like a soap opera where you might miss a week, and some things might feel wildly different, but it's kind of the same thing.
Yeah.
It really is. It really is. So, all right. So I see there's a bunch of questions in the queue. And again, we hang the valuation theme on the 3 p.m. Eastern hour most days. And we'll talk about some valuation, fools. So if you have questions about valuation related things, get those to us. But if you have other questions too, get those to us as well. Slido.com. The event code is Fool24. Dan, always like to remind everybody watching too at the beginning of the hours, this is not personal advice. We're not giving individual investing advice for a litany of reasons, legal, ethical, and otherwise.
Can't do it.
Can't do it. Not going to do it. But we will give our opinions, and then you can use those to inform what you choose to do. But you have to own your decision and reach it based on something more than just a couple of guys on the internet.
We promise we will not be offended if you end up doing exactly the opposite of what either one of us or both of us say. Be your own person. There's more than one way to win, for sure.
Well, that's interesting, Dan, because you and I think we're like maybe there could be a white paper on the different strategies that we've taken as investors to arrive at the same goal of reaching our financial goals. And I think we both done pretty well over the long term too. So
yeah.
Works out. I'm going to take this, if you don't mind, Dan, I'm going to take the very most recent question that came in
Jump in, buddy. Yep.
Jimbo has a question. So Broadcom, the ticker's AVGO. Broadcom reports after hours today. Asks, what is your expectations for Broadcom in the next 2 to 5 years? So that's a really hard to answer question. So Broadcom, semiconductors, they do a lot of stuff in the semiconductor industry, software technology broadly. It's a interesting business. It's kind of like Frankenstein's tech business. A lot of acquisitions over the years to bolt on to create this business. And they've managed to integrate a lot of it really well together. And right now, the tailwinds are very much accelerated computing, which is AI, the cloud, writ large. And the business is built to benefit from those things. Last quarter, when they reported, results were good. I believe it was around that time that the stock joined the 4 comma club for the first time, became a $1 trillion market cap stock. I'm not sure where it is today. I know it's given back some gains recently, but expectations continue to be really high in the near term because of all of this infrastructure build out that we're seeing around AI and the cloud. That's likely to continue for some period of time in the foreseeable future. I think the problem that I run into, and a lot of the smartest people that I know, what you're going to hear is the people that have a dog in the fight, that are executives at these businesses, they're less likely to say what I'm going to say out loud. But the analysts that follow it, that know a lot about the industry, they're going to say a lot of the same thing. And the idea is that we know we're going to continue to see a lot of CapEx and a lot of spend that's going to be concentrated to a handful of companies on the hardware and software side, like Broadcom, Arista Networks, NVIDIA, a lot of those companies, Supermicro Computer, Dell, companies that are building the servers, the companies that are building the data centers, right? There's a concentration of that capital that's flowing to a few dozen companies that are getting a lot of it, right? What we don't know is that when is that going to slow down? Eventually it's going to. Right now it is a race to build out capacity. At some point the capacity is going to meet the need, and the growth and that spend is going to slow. We're going to go through a cycle where companies pull back on their capital spend to reevaluate what their plans are. That's probably going to happen sometime in the next 2 to 5 years. It may take longer than 5. We don't really know until we see more about the monetization of AI broadly. We've seen the cloud, Dan. Companies are making a ton of money selling cloud infrastructure. The hyperscalers are making a lot of money, a lot of margin dollars on that. We're starting to see signs that companies are starting to monetize AI more broadly, but it's going to have to get monetized a lot more to justify the expense that we've seen. So that's partly going to inform it, like the acceleration of AI and the cost curve of AI coming down to get to the point where more adopters of AI are driving the revenues behind it. They're going to create the value. So all of that to say, I think answering that question is, what is a stock like Broadcom going to do in the next 2 to 5 years based on the business? What is the business going to do? It's a little bit hard to say, because even as much as the stock has come down, there are still really high expectations. I'm thinking 5+ years, it's a little easier to predict. The business is probably going to be larger and more profitable, but the valuation is stretched. I think there's a very real scenario from here where maybe you don't get market beating returns starting from high expectations and a high valuation. History tells us that sometimes we get subpar returns coming from that point, even when there's a lot of growth opportunity. But when you're talking about a company as big as Broadcom is, with the valuation where it is, anything to add there?
Yeah, just we did get a comment from Matt, and I did check in Jimbo. Broadcom, ticker AVGO, not reporting today, Wednesday, March 5th. They are reporting tomorrow, Thursday,
Tomorrow.
March 6th, after hours, with the conference call starting at 5 p.m. Eastern time on March 6th. So that is tomorrow.
Right.
And with respect to to the actual question, I think that one thing that you really have to think about with this is how much you are hinging on, like Jayson said, how successful monetization of AI is going to be. And AI skeptics kind of got an unexpected person in their corner in just the past week or two. Satya Nadella, CEO of Microsoft, ticker MSFT, kind of trying to pour a little bit of cold water on some of the AI hype talking about how, you know, there's a huge amount of investment in AI. There are a ton of AI projects going on. Nadella seemed a little bit skeptical that all those projects are going to pan out. I think the question that investors have to ask themselves is that you had, I mean, everything we do in life is a prioritization of ideas. We have our best ideas, we have our second best ideas, we have our 10th best ideas, and you go on down the list. And anytime that you have a new technology, you know, think about the internet. You know, the first internet applications that came out were highly successful. You know, they found their niches. They developed new markets, things like e-commerce, things like, you know, information search, internet search browsing, that kind of thing. You know, those were the top ideas. They had the most staying power. They had stuff that you could do. And then, you know, at the other end of the spectrum, you have, you know, these sort of .com jokes, and, you know, insert your favorite one. I don't have a particular favorite, but just adding .com to the end of whatever company name that you had, you know, was enough to get you a short-term stock pop, but it wasn't enough to create a good business model out of what was not a good business model.
Right.
And
right.
you're going to get to the point now, you know, most new technological innovation kind of hits that direction where, you know, there are great AI ideas and they're going to keep coming out, but demand for any AI ideas is going to generate some losers. And the question becomes, at what point do the ideas, you know, get to the point where you have a diminishing marginal return from additional investment in that, when a company the size of Microsoft kind of points a spotlight at that fact? Yeah, it's a good reminder that you can see short-term drops. Broadcom down about 20% from its highs less than a month ago, but still, you know, rocking and rolling, up 45% in the past year, and much stronger over the past several years.
Trades for 47 times free cash flow. They're coming off record free cash flow. The EBITDA margins and the free cash margins the business generates are extraordinary. So to a certain extent, it is the sort of business that should trade for a premium valuation because the profitability is so apparent and impressive. But eventually, like Nadella pointed out, I've talked about it's end markets are cyclical, and at some point that cycle will turn. And it always turns when companies are at, you know, all-time levels of profitability. But if you look at this company, its free cash flow has continued to move higher consistently every year, going back to 2019 was the last time we saw a little bit of a dip. It slowed a few times here and there, but generally it's continued to march higher. So just buyer beware if you're looking at stocks and you're thinking in these short-term horizons, which 2 to 5 years, that's short-term, particularly for businesses that have really big cyclical exposure. All right, Dan, what's next?
Jimbo has another question. Oh, sorry. I have to do this every time. Jimbo has a question, has another question.
Has a question. That's right.
How is Blackstone, ticker BX, going to fare in a tariff environment? So
yeah.
Financial services always an interesting thing to look at, especially investment related, because, you know, you have to look at the underlying businesses in which Blackstone invests, the themes that Blackstone has tried to capitalize on, the ability for Blackstone to pivot away from themes that may not work as well toward themes that may work better in a new environment. Some quick research that I was able to come up with. You know, Steve Schwartzman kind of I'm not sure if founder is the right word, but you know, when you have the
business was built in his image is the best way.
Yeah, I think that's the, you know, and definitely, you know, longtime CEO Steve Schwartzman just wrote a book. And, you know, it's important to remember, you know, Schwartzman actually helped out President Trump during his first term, you know, dealing with tariff issues. And so if there's an angle that he can see, you know, that anyone can see towards pivoting to profit from this, it's probably Schwartzman. As well as that, Chief Operating Officer Jonathan Gray, you know, has done some interviews lately. He points out the obvious fact, which is in a new tariff environment where things are changing every day. And, you know, I'm looking at, you know, you go look at the head page of Yahoo Finance. there's another headline just breaking here. I haven't confirmed it, but it's from 53 minutes ago that Ford, ticker F, GM, ticker GM, Stellantis, ticker STLA, granted tariff exemption after a Trump call. The headline says it's a 1-month reprieve from the tariffs imposed, 25% tariffs imposed on trade from Canada and Mexico. That kind of uncertainty, I mean, short-term uncertainty is hard for any investor to deal with, but extended uncertainty is something that an adroit investment manager can intuit better than another competing investment manager. And in my view, Blackstone has a good competitive advantage. Certainly not the only high quality firm in the business, but definitely has stuff going for it. I am a Blackstone shareholder, I will disclose. And, they've just had a good business model. I think it really just depends on how well they're able to read the leaves and investor confidence. I mean, this business, it's, high-end investors aren't going to panic because the NASDAQ's down 6%, 8% from its highs.
It's one of the reasons that they've invested
non-event.
capital with these alternative asset managers
Exactly.
is because they want uncorrelated investments.
Yeah. So
Dan,
I don't see the tariffs having a big impact, because I think that if anything, the volatility creates an opportunity that it's going to be able to capitalize on better than other companies trying to do the same thing.
That's the key. I want to build on that and go and we'll take Blackstone. Let's put KKR in the conversation. Let's put Brookfield Asset Management and its parent company, Brookfield Corporation, in the same conversation, because we need to talk about the stocks and then we need to talk about the businesses and the customers that they serve in a little bit of different ways. If we do see extended tariffs play a role in leading to recession, which other factors may be involved, leads to a downturn in the stock market, right? Whatever the catalysts are that cause a downturn in the stock market, rest assured that the stocks of these companies are going to go down too, because everything's going to go down. That's what happens when we have a big bear market, downturn, crash, whatever it turns out to be. It's going to happen, right? But going back to the core businesses and thinking about the markets and the clients that they serve, they win because they always have money when nobody else does. Blackstone it has a pretty sizable private equity business. It used to be like real estate was kind of known as real, but it's pretty diversified now, and its private equity business has grown. So they own a bunch of businesses. Some of those businesses are things like restaurants. Tariffs are likely to be really bad for restaurants, because if consumers get squeezed, they're less likely to go out to eat. And guess what? We get a lot of from Mexico, produce, so a basic input for restaurants. So some of those operating units might get squeezed, but I promise you, the Rolodex of the asset managers in these businesses that run these funds that are investing capital in all of these different assets, their Rolodex is full of businesses that they would love to invest in or own. And when those businesses are at a point where they need liquidity, who can provide them liquidity very, very quickly? These asset managers. So they're built to win. When these environments happen, they're built to do things that make the business stronger on the other side of it. And that's one of the most impressive, valuable things about them, is it allows you to take a stake in a business that's pooling the capital of some of the wealthiest people in the world and developing a return for those people and earning a really attractive fee along the way. And then you get to participate in that. I love these businesses as counter-cyclical ideas.
I got to ask you a question, though, Jayson, as my resident Brookfield expert.
Yeah.
In context of the tariffs, it's really interesting to me. Brookfield Asset Management, ticker BAM, recently changed its headquarters from Toronto to New York City. And one of the leading candidates to take over the Canadian Liberal Party, Mark Carney, who's formerly of the Central Bank of Canada, if I recall correctly, was affiliated with Brookfield. And there's some controversy about whether Carney essentially was a traitor to Canada by recommending that move. in the headquarters. Obviously, Canadian nationalism inflamed by President Trump's tariff discussions and discussion of annexation of Canada and things like that. But anything. Do you think Brookfield loses anything if it becomes the scapegoat for Canadians, or do they win more by moving to Wall Street, or any thoughts about that?
Yeah, no, they're the native stock exchange started off for the Brookfield families as the Toronto Exchange. They all trade on the New York Stock Exchange now as well. There's your investor capital for your float, for your stock, and then there's where your money comes from. And where their money comes from is high net wealth investors, pension funds, goodness, what are they called? The endowments, sovereign wealth funds, family offices. And New York is the global center for that. It is important for a business that has the ambitions to grow their AUM at the rate that they want to grow, to have proximity to that money. So yeah, I think it's a non-issue in a few months. I mean, I think some of their other businesses, like their corporate domiciles, are in some of the offshore islands. So
yeah, indeed, I'm seeing commentary that suggests that one of the reasons that they moved their headquarters to New York was in hopes of qualifying for inclusion in U.S.-based stock indexes. That would be a potential source of capital.
This is it's a big reason they created the corporations for the subsidiary operating businesses, is to be potentially inclusive into indexes. So that's part of the long-term plan, is to increase the addressable pool of investors, but being closer to where the capital is probably a bigger thing. And the biggest thing that's interesting about the Brookfield businesses, and this is something I didn't realize, but it's just kind of a coincidence as much as anything, I believe. I don't know that it was intentional, but the operating businesses don't do business across borders. They operate where they're based.
Yeah.
So they sell their product or service, manage real estate that they own. It's domiciled within the country that subsidiary is based in. So those businesses are actually positioned to not be negatively affected by tariffs.
I mean, they'll need to import materials the same that any business would need to import materials to some extent. So, the point just being that the structure, the corporate structure, does not add to the problem. That it's just something.
But the subsidiaries,
exactly,
whatever they're producing, they're selling it to customers. The renewable energy businesses, they're producing power in the U.S., selling it to U.S. users, for example. So
exactly, yeah. It just may be that if they have to buy solar panels or turbines or whatever they have to buy, they may still have to import overseas, those things, of course, just like anybody else trying to you're not necessarily going to find those homegrown in every country that you're doing business in.
No, absolutely not. That's exactly right. So Jimbo has a question, does point out, and I think this is important, just to be clear, the Broadcom is not only an AI play. No, it's a technology company, but the biggest catalyst for its growth right now is the capital investments in accelerated computing. And I want to be clear, I said accelerated computing because that's a lot more than artificial intelligence. You think about the cloud broadly, accelerating computing is more than just AI, but that is the biggest tailwind of growth for Broadcom right now. Okay, what's next?
You're up, buddy. Pick one.
Me? Okay. All right, you got it. Let's see here. If you had any thoughts about Zscaler? Zscaler, I don't think, does Zscaler report today?
It does. I did check. All it takes is one to make me wonder. Okay, yeah.
Question everything, Dan.
Is everybody gonna get their earnings dates right? But yeah, Zscaler is set up to report.
Vihan asked a few minutes into the hour. Zscaler reporting today. That's ticker ZS. Should we expect similar tailwinds as CrowdStrike, which was down? I didn't see it come down that much, but I know it was down a lot after earnings. So Vihan, this is interesting, right? Because Zscaler, for a lot of investors, has been a bit of a conundrum more recently, while CrowdStrike seems like it's kind of met a lot of the questions. Although maybe there's a few more questions about its ability to attract new business. And I'll talk about that as the context here. But if you look at Zscaler, while CrowdStrike stock largely moved up and through the outage last July, and then they've reported 2 full quarters of results since then. And I'll talk about the impact of, or maybe some implications in a minute. The growth has continued. The strong cash flows have been apparent. And the stock has done really, really well. Zscaler on the other side, the stock has been extremely volatile as the results really haven't completely met expectations. Growth is decelerated. It's still growing, but growth is decelerated. So I think maybe the difference is that Zscaler, Dan, might be coming into this quarter with low expectations or lower than in the past, because the business just hasn't met the expectations from investors writ large for, I don't know, maybe a year and a half now. While CrowdStrike largely has answered the bell. I'm going to do a screen share here, using just this visual to kind of help put it in perspective around the market's reaction. So back at the beginning of last year, when it reported its Q1 results, stock went up, down after earnings, down after earnings. This is kind of the tech stock sell-off that we've seen over the past couple of weeks here. So again, the tail there of that image is not meeting expectations that were pretty high. CrowdStrike has been the inverse. However, I want to say this about CrowdStrike, because the one thing that I did notice when I went through its results was a few things that really stood out. Growth rates have continued to slow. They're saying it's going to slow even more in 2025, in their current fiscal year, down to close to 20, I think right above, you round it up to 21% revenue growth is what they're guiding for. Now, historically, they usually do better than their guidance. They've been pretty conservative with their guidance. But then you start peeling back the layers on profitability and how they're acquiring that growth. There's some questions. Gross margin has come down a little bit from where it was before the outage. The first couple quarters reported in the year, margins have come down. And typically what you've seen with the company over its history is as it's scaled up, its gross margin has expanded. So that's flattened to reversing a tiny bit. And then you look on their operating expenses and some things really stood out. The biggest thing is their sales and marketing expense is skyrocketing. For the full year, it increased almost $400 million. It was up about 40% in the fourth quarter. And you look at the margins and the revenue growth, and then you look at their operating earnings numbers that they're putting out there, and it tells the tale that that paying up for growth is going to continue. Because if you try to draw a line to somewhere on their results that's deteriorated, and now we do have 2 quarters in a row where net new ARR is growing, but it's growing at a much slower rate. That number was growing really well through the quarter that they reported. That was the last quarter they reported before we saw meaningful results after the outage. And then the last 2 quarters were fully after the outage, and we saw net new ARR decelerate in that first quarter they reported, and then it decelerated even more in this quarter, while their sales and marketing expense has skyrocketed. So they're really having to pay up to attract and acquire net new business. Their churn rate's basically the same. It may be just a little bit, tiny bit higher, but really close to the same. That says their existing customers seem to be pretty happy. But the growth rate is net new ARR is slowing. And also now the metric, I can't remember the metric in my head right now, but it's dollar-based net retention. So it's kind of like a comps metric that has also continued to decide. It's still pretty healthy. It's in the mid 117%, I believe was the number. That's still really, really healthy. But again, it's not as good as it was. So the question that we don't really know the answer to is how much of this is just the market is maturing and the sales cycles are maybe taking a little longer than they were in the past, or how much of it is there's still some reputational harm. And also maybe harm, maybe too strong of a word, but maybe chief technology officers out there saying, or in security executives are saying, we need to shop around a little more. And some of them are saying, you know what, this security SentinelOne, they're not too bad. We'll do them. Or some of the products from some of the other competitors out there, some frenemies out there are good enough and a lot cheaper. And CrowdStrike is not winning on the margins in the same way that it was before. I think it's still a wonderful business, but those are questions that CrowdStrike has to answer. Zscaler, I think, is the other way around. It's the expectations are pretty low. And can they start overachieving and getting closer to those higher expectations of the past? Dan, you got one you want to grab here?
There are some trends, though, in there that I think are worth paying attention to, both for CrowdStrike and for Zscaler, and for to a large extent for software as a service, subscription-based business models entirely. One of those is we've seen a shift. We started to see a shift. Back in the day, you bought license-based software and you paid once and you got that software and you kept it as long as you wanted to, but you didn't get any updates. And so, over time, eventually you'd upgrade, you'd pay another license fee, and you get the newer software, and things went fine. Software as a service came out and said, hey, that doesn't make as much sense as, we don't really want to have to force people to upgrade. We want to just provide the upgrades as they're available. And so rather than paying us a big, expensive one-time license fee, why don't you pay us every month? And that was especially attractive for customers that were in the habit of upgrading whenever new technology became available anyway. And so that worked. And for a long time, it was something that, distinguished software as a service companies was they didn't have this lumpy income. They had relatively consistent recurring revenue to come in month after month because of the nature of these subscriptions. Now that model seems to be evolving a little bit, and people are trying, businesses are trying to figure out, okay, if we charge everybody the same amount, well, there's some customers that use us more than others. And yeah, we can have pricing models that, charge something extra for a given module or a given feature or something like that. But really what we want to do is, if we expect demand for our service to go up over time, we want to charge on a usage basis so that as usage goes up, we can participate in the profits. And so you're seeing some companies do that. But I think you're also seeing some companies that may be contemplating that, but not seeing the sticky pricing power demand that they would like. And so they're kind of boxed into a corner where there is a potential that they are going to lose business to, whoever the leading provider of that service is, who does have pricing power, if any. If it turns into a commodity service, then kind of nobody wins, because then you start to lose some of the profit margin area. The other trend that I see is that as companies leverage artificial intelligence to a greater extent, and as various platform providers try to incorporate AI into their offerings, I think you see a blurring of the lines between certain niches that you wouldn't have thought were overlapping in the past. In addition, I think AI offers at least the potential in the long term for companies to kind of re-internalize some of these services that they have delegated out to third-party providers like CrowdStrike, like Zscaler. If you can get from an AI services provider writ large, if you can get integrated cybersecurity services, if you can get integrated zero trust services, identity services, all the things that you need to protect what in many cases now the business's greatest, most valuable asset, its data. If you can get that coverage from an AI model, then you get to the point where it's like, do I want to have one service, or do I want to have AI doing this and cybersecurity over here doing this and some other service doing this? In general, what you'll find, those AI models work best when all the data is in the same place. And so if you can integrate that, it's going to be an advantage to companies that can create that one-stop platform. Not to say that Zscaler isn't the one that could win, not to say that CrowdStrike isn't the one that could win, but only to say that there may be a list of winners and losers that is, where there's a smaller number of winners than there has been so far. At this point, a whole bunch of companies have made the case to their business clients, hey, you need us. Even if you still need those other guys, you need us as well. And I think that trend is starting to work against us.
Yeah, I think we're going to see more consolidation across this industry, and some of these companies are going to become features of other companies' offerings. So we'll see how that goes. All right, you want to take Let It Ride's question?
Let's do it. Any thoughts on New York Times, ticker NYT, and its valuation? Looked it up. PE ratio reported on Yahoo Finance looking at around 27 times, which when you think of it as a newspaper company, you're sort of like, whoa, I didn't know there was a newspaper company out there that still had a roughly market valuation. But New York Times, interesting story. I mean, turn the clock back 10 years. How many people would have thought New York Times was going to be gone? Like it just wasn't going to survive. But they have done an incredibly good job of making the digital transformation, understanding that printed newspapers is the stub business and that they needed to enter the 21st century with a vengeance. They have done a good job of that, of building up online digital subscriptions, of building up bundled services, of building up brand name loyalty. It's funny. A lot of it's games. I mean, how many years ago was it that New York Times bought Wordle? I think it was.
And
everybody's
years
like,
ago now. Yeah.
Everybody's like, you paid that much for a game that what were we thinking? But it's that kind. Now there's a huge range of games, and I think that a lot of people do the subscription for the games, or they'll keep the subscription for the games.
Yeah.
The other trend that I'll point out that at the time I was sort of like, boy, this might be a bad move, but as it turned out, was ahead of its time in terms of the political wins. New York Times did a really good job. There was a time when the New York Times was seen as having a very distinct political slant. And they moved away from that political slant several years ago, started to include content that really riled up people who had previously relied on that newspaper to be the guardian of a particular point of view. And, at the time, it was easy to point to them and say, oh, well, they're just kowtowing and, that they're giving up on journalistic ethics and things like that. Well, fast forward to 2024 and you have other publications that, have come into the spotlight. Washington Post, is the first to come into mind, but other media outlets as well, where you see some similar shifts in, what has traditionally been kind of the historic slant, historic brand of, perception of the business. And so I think it has served New York Times well in hindsight to have made that move, to have identified the importance of making that move before it was so obviously a pivot in response to a specific individual political event. And as a result of that, I think, obviously you want to be able to appeal to as broad an audience as possible and position yourself to be the news source of first resort. And I think New York Times has done a good job of that. Other thing I'll just point out, New York Times has been in the forefront of defending its intellectual property rights against artificial intelligence models, of trying to negotiate licensing deals that recognize the value of the information that it has accumulated and distributed over time. That is something that I think will only gain in importance. At the same time, it has not hesitated to be litigious as well. There are some court cases out that, the eventual disposition of which will say a lot about what AI producers, model producers will be able to do with information that has been released into the, I can't say released into the public domain, but released into people's, in front of people's eyeballs, and the extent to which, once that happens, it is fair use to use that information or not. It could say a lot about what happens going forward. But it is just, it has made itself into a much stronger business than a lot of people ever gave credit that it would ever manage to get to the point where it had recovered to.
There's some other things that the Times has done really well that's created a lot of value for the business. and it's more around some of the lifestyle products they have. So the New York Times Cooking, for example, acquired The Athletic, and they've made some moves to try to improve the monetization of that. The New York Times has never had a big sports reporting business, so adding that into their quiver. Wirecutter, which is the consumer products review business that they have, a lot of different things across a lot of different sources of data and information that people might want, that can fit into different lifestyles that they've been able to monetize, that have created stickiness. And they've built a digital news source that's more like traditional news, but that seems to work and fit within the way more and more people are thinking about how they use the internet for getting news. So kudos for the business that they've built. It's been pretty fantastic. I got another question from Jimbo. Has a question here I'd like to talk about. Dan, this is one that we can both weigh in on. Jimbo has a question, writes, how do you give a value to high growth businesses having positive earnings or not? And I love this question because one of the hardest things to do, particularly for newer investors that haven't spent the time and looked at high growth businesses that are still early in that phase of building something that's going to generate cash and be profitable. How the heck, there's no PE ratio if a company's not earning money, right? So that makes it harder to do. So when it comes to valuation, I have a bunch of different, not a bunch, 4 or 5 different buckets that I like to put businesses in, stocks in, based on where they are in the continuum of their existence as a public company. So on one end, you have the large, predictable revenue, predictable income, not super cyclical, relatively uncyclical, or very resilient businesses where the PE ratio is pretty easy to use. Price to earnings, price to free cash flow, because these companies have long histories of earning money, growing that earnings per share at some rate. And that makes it easier to, within some range of probability, use that ratio looking forward over the long term to try and find a good value. And with these businesses, Dan, getting a good valuation, assuming the business is still operating well and they're doing a good job and they are getting operating leverage, or if they're only growing sales 4 or 5% a year, but they pay a dividend that's 2 or 3%, and they're taking that 4 to 5% of revenue growth, and they're getting high single digit earnings per share growth. You take that, 7 or 8% earnings per share growth, and you put a 3% dividend on top of it, and all of a sudden you're talking about market level long-term returns, maybe a little bit better. Right. Just if the valuation stays the same, right? But if you're paying a premium for that business, you're buying it well above its long-term average, you're immediately putting in a big headwind. Maybe you're not going to lose money if you hold it for 5 or 10 years, but you're probably going to get subpar returns because you're starting from a high valuation in a business that can't grow into it as well. So getting a good valuation on those businesses is so important. The other end of that spectrum is companies that don't have earnings yet or don't have positive cash flow. This is why a lot of times you hear metrics like price to sales get used. If you're using price to sales to value Walmart, you're probably going to buy Walmart at a bad price because you're probably going to be comparing it to Amazon, which has this high growth, high profit tech business that's built on top of its retail business. So you're prone to mistakes when you're using the wrong metric to justify buying a stock versus trying to make sure you're paying a reasonable price for what you're getting. Price to sales can be useful directionally with these businesses that are at really high growth rates when you compare them to somewhat similar businesses across their continuum of growth to try to make sense if it makes sense. But then you still have to, this is what I do. I think most investors that have been successful looking at these companies that aren't making money is trying to figure out the directionality of the economics of their business. Are they burning less cash? Is that trend getting better? Are their margins improving? Are the negative, if they have negative operating margins, are those getting closer and closer to break even to positive? And you look for those businesses to try to get to that inflection point where now all of a sudden they're breaking even, and you're projecting, just like you're doing with the other companies, you're projecting them getting to a point where they're generating earnings and free cash flow and growing that free cash flow per share at a high rate. Those companies, again, you want them to be growing really quickly because you want them to grow into it, to grow into the valuation. But paying a premium for those businesses is, the idea is you're buying future earnings, right? So for me, when I think about margin of safety, how can I limit my risk of permanent capital loss? It's having a long time horizon for those businesses, right? That's where you try to get there. If they're good operators and their product is strong, for example, a CrowdStrike, if you bought it back in 2019, the valuation then was a lot higher than it is now, and it was burning a bunch of money. But the direction of its growth, the quality of its business, the rate of growth within its existing businesses, the net new customers it was adding, and the shrinking cash burn, we're pointing towards an inflection point where it would start to pump out free cash flow. And it's been doing that. Now it's pumping out that free cash flow. So that's kind of how I think about it. There's a whole range of other buckets that I have in there for other kinds of companies and cyclicals and companies in different industries. And I won't even talk about deep value and that sort of thing, but that's kind of how I think about it. Dan?
So I do want to point out, Jayson, I think you're absolutely right. You have these companies at different stages of life cycle, and the market, the investor community is going to view them differently. They're going to use different metrics as long as they can. But the thing to bear in mind is that it's only partially based on where in a life cycle a company is. It is also based on what the market's expectations are at any given time. And the point that I want to make with this is that you as an investor do not necessarily get to pick when the market is going to pivot away from a general tolerance to pre-profit companies that have reasonably good sales growth and at least visible prospects for long-term profitability versus companies that aren't making a profit now, don't have any clear pathway to profitability in the near future. At some point, sometimes the market just shifts polarity and north comes south and south comes north. And suddenly that stock that you had that everybody was excited about, now everybody's like, show me the money. I want to see profits now. And you're like, guys, I am not going to give you profits now. And I've told you that for a long time. This is a company that it's going to be 3 to 5 years before you're going to get profits. And suddenly the investing community says, well, yep, that was fine 6 months ago, but it is not fine now. And as a result of that, you see valuation compression, you see sales multiples go down. And that's just something that you kind of have to deal with over time. I'm going to grab a question from Ed from 34 minutes ago. In a week, AST Space Mobile, ticker ASTS, has gone up from 24 to 34. Besides being unprofitable, what else is wrong? How far can it go up? So AST Space Mobile issued its fourth quarter financial report late yesterday. I will admit I do not follow stock very closely, but I have followed space stocks in the past. ASTS is building a space-based cellular broadband network intended to make cellular broadband available to areas where ground-based communications makes things difficult, whether it is in terms of remote location, whether it's in terms of terrain. Just about all of us, well, okay, that's not fair at all. Those of us who live in communities that have any level of terrain, so if you're not in the flatlands, if you've got hills, if you've got mountains, wherever it may be, just about everybody knows there are dead spots. And the question becomes, are those dead spots areas that could be served better by something from overhead than by something based on a land-based tower? And for many, in many situations, that is something that, it gives appeal to a company like AST Space Mobile to be able to get that done. Obviously, launching satellites to provide cellular service is a huge capital investment upfront. And as a result of that, it is something that that investors have to really take into account. I think that is one reason why you see volatility in both directions with this stock more than others, just because, you know, there's so much question. When you have such a big capital investment up front, question becomes, you know, are they going to make it? Are they going to run out of capital? Are they going to have enough capital to get through? If they run out of capital, are they going to have to raise more? And how are they going to do it? Is there going to be debt financing available? Well, now interest rates are higher than they were 2, 3, 4 years ago. That makes it more of an area where you might want to do equity financing. But if you have to do equity financing, you want to do it at a time when the stock is doing well, like now, rather than waiting until the moment that you actually need it and doing it then. I will note it that on the quarterly call, and I'm trying to find the exact slide to come up with the numbers, but they've been doing a good job of building up liquidity with a cash position of $568 million now. It's up considerably from where it was 12 months ago. It just kind of goes to show that, you know, I think the company's doing a pretty good job, both execution wise and in terms of preparing things for the future. So Dan, Jayson has a reveal to do here, it looks like.
I do. Before I do that, though, I just sent a screen share across. Natasha, if you can release it to share. So this is, I think it's just really telling about the whole space rockets business industry right now. So this is year to date. So the purple's Rocket Lab and then AST Space Mobile. Now, obviously, the directionality is a little bit different in terms of one is up so far, one is down so far. But like if you look at the individual days, you see just this strange, like this really high amount of correlation. Now, the directionality sees a little bit of difference in the way the markets interpreted their earnings more recently. But the point is that when you see that kind of correlation, a lot of times it's in industries where there's a lot of speculation, Dan. So there's still so much speculation out there.
So, Jayson, I noticed you've lost your video.
Oh, no, I haven't lost it. Had a reveal.
Oh,
yeah. John Gallegos, I see you. I see your comments. And we are here to serve. We're here to serve. I have broken out the Braves gear just for you, John. All right, now ask us a question. Oh, you did. Any thoughts on some additional companies with similarity to Brookfield Infrastructure with the build out required for the next 5 to 10 years? So beyond Brookfield Infrastructure, which owns infrastructure, and the opportunity is the dividend yield and being able to grow that and growing the value of those assets over the long term. Brookfield Infrastructure tickers BIP and BIPC. Where I've invested largely is the companies that are either building and servicing it. That's Brookfield Infrastructure. So companies that I like a lot that participate in this. IMCOR, I think, has gotten more attractive as the prices come down, with the right expectations in terms of its growth rate. But as we continue to see this, the energy transition, the electrification of everything, more and more of the supply chain shift into the U.S., there's a lot of build out that's going to continue to happen. The demographics in the Sun Belt, where more companies and more operations are being moved there. IMCOR did an acquisition at Miller Electric. They spent $865 million to buy a company to give them more geographic exposure to the Southeast, particularly in Florida. I like IMCOR a lot as a long-term investment on infrastructure spend. I like Chart Industries a lot. If you think about the increased demand for cryogenic gases for LNG exports are going to continue to grow. The biotech industry uses a lot of cryogenic gases, food production. Now we're starting to see these sorts of needs for data centers, for liquid cooling, for servers. So I think Chart is a really interesting play on that. Dan, any others that come to mind for you?
Oh, geez, there's a ton of companies in the infrastructure
Lincoln Electric
space.
is another one you can put in that boat.
It's all these names that you're sort of like, don't talk about them at cocktail parties or you put everybody to sleep. But
yeah, exactly right. Yeah,
but yeah, I'm kind of spacing on individual names at this point.
Yeah,
but
Lincoln Electric's interesting. I think the stock might be a little rich right now, but that's another one, particularly if we if it's just such a big mature company, but you don't see a lot of industrial manufacturers, Dan, that I was looking through their results, kind of the long term. This blew my mind over the past 25 years. So what is that? 25 times 4 over the past 100 quarters. They've only had 5 quarters that they didn't generate positive free cash flow. 5 quarters out of 100. Every year since 2000, they've generated positive free cash flow. They've had 4 different periods where their revenue fell 10% or more, and they still generated positive free cash. You don't usually see that with companies that they make welders and they make welding supplies. That's their business. But the recurring revenue stream from the supplies part of their business and the services part of their business is a big reason that it's managed to stay profitable through those environments. Exceptionally well run. I'd like to see a little better price on it, but that's exactly the kind of business that's built to benefit from infrastructure need.
Yeah, one I'll throw out there is Watsco, ticker WSO.
Yep. Mm-hmm.
You know, and you've seen you see migration to the Sun Belt, and a lot of building in the Sun Belt. Well, if you're going to build in the Sun Belt these days, you need a good HVAC system. Watsco's done a good job taking a still very fragmented industry. I mean, I don't know about you, but if I need to call somebody to service my furnace, it's a local person. I mean, and I know that one of my providers just sold their family business to another family business. So now it's, a double-sized family business, but still a family business. Watsco's done a really good job of cherry picking the best family-owned businesses across the country and turning them into a scaled-up operation, keeping their management local, keeping, kind of a Berkshire Hathaway, Warren Buffett model of, they're not imposing centralization on the business, but they're giving the advantages of having a centralized framework available so that access to better technology, better order tracking, better supply chain, all kinds of things that small businesses struggle with, Watsco's able to step in, give cutting edge, state-of-the-art, top-of-the-line technology in the HVAC space, in related spaces. And you're just going to see a huge amount of demand for that, whether it's because of housing shortage, whether it's because of, nearshoring of commercial operations, all kinds of trends favoring that going forward.
All right. So John Gagos gives his approval. JS says, let's go Mets. Jeff Santoro, shut up, Jeff. I'll see you in 5 minutes. Vihan says it's 3 days. Appreciate it. If you can spill out what you added to. I'm sorry, Vihan, it's only been 2 days. It has to be 2 market days after. So we've got to wait one more day. One more day. Please be patient. I promise I will tell.
You've got a fan, Jayson. He's counting the days.
I'm sorry. It was Monday. I made some buys on Monday, so it's putting everything off. So let me take. This is a good valuation question as we're starting to wrap this up. I want to take this. Amar asked, would you derive any conclusions using trailing and forward PE ratios? Offered a lot of examples. I want to talk about this briefly because this is another big valuation thing that is a little bit of a pet peeve for me that I think is misunderstood, and we use it sometimes to justify things instead of really fully understanding it. So the trailing PE, this is the price earnings ratio based on the company's prior 4 quarters earnings, trailing 12-month earnings, right? So it's looking backwards. There are big limitations with that. Cyclical companies that had one-off items that made their earnings look really good, companies that had one-off items that made their earnings look really bad. Those, you have to understand the context of what made the number the number. And then you turn around and look forward. So what is a forward PE ratio? Nobody has the crystal ball here. This is analyst consensus estimates for earnings. It's the PE ratio looking forward based on Wall Street's finest's best consensus guess. By the way, their guess is not GAAP earnings. It's an adjusted number. One of the reasons you see companies report adjusted results is because it's what Wall Street wants to hear. They want the adjusted numbers that they're using to build their models around. So you're using an adjusted number and if you're comparing it to the trailing, you're comparing an adjusted number to a GAAP number. The adjusted number almost always looks better. The PE ratio is lower because the adjusted earnings number is usually higher. You're not comparing apples to apples. Be careful with that, okay? Now, there are some things we can learn. All things created equally, if the PE ratio going forward is higher than the trailing number, and there were no weird adjustments that came into play, that means the market's expecting the company's earnings to go down, usually. If there's a big lowering of the PE ratio, the forward ratio from the trailing ratio, if there were no big adjustments, that means the market is expecting the company to earn more money. Again, on an adjusted basis, you got to think about that. But in the case of like CrowdStrike, for example, trailing PE ratio really high. They lost their GAAP earnings were really bad the past couple of quarters. I shouldn't say really bad, but they were down a lot because of some reasons of numbers that some adjustments they had to make related to salvaging some business and some deals. So they're expecting on an adjusted basis, it looks a lot better. So this is one where you're comparing a GAAP number that had some one-offs that makes it look really high to an adjusted number looking forward that makes it look a lot cheaper. So it can lead you to bad conclusions about the valuation.
I'll just note one of the examples that the questioner asked was on Berkshire Hathaway, ticker BRK-B. And Warren Buffett has said specifically, do not pay attention to earnings. With that company in particular, the stock performance of its portfolio of businesses, or rather of publicly traded stocks, gets marked to market every quarter. And so what you have to do, you have to look beyond that to operating earnings or earnings from the operating businesses in order to get a better number there. So there are always some specifics that you have to pay attention to.
Well, and Apple, and they realized so many gains on the sale of Apple last year that
exactly.
It's definitely making that PE ratio trailing look better. Dan, we're out of time, and it's time for a pause here.
Yeah, we are taking a short break while we end our YouTube stream version of Fool24. But Motley Fool members, do stay tuned because we have Toby Bordelon and Rachel Warren coming up here at the 4 o'clock hour on the East Coast talking about earnings. So until later, thank you, Jayson, for joining me. I'm Dan Kaplinger. Thank you, Natasha Hall and the rest of the production crew behind the scenes. Join us again. YouTube folks, join us again tomorrow. And Motley Fool members, stay tuned. Thanks for being with us. Have a great day.
See you, fools.